Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's jump right in. Today, we're cracking open a true investing classic from way back in 1960. It's a book that, honestly, is so on point, the wisdom in here feels like it could have been written just last week. We are talking about Philip Fisher's Paths to Wealth Through Common Stocks. And hey, you don't have to take my word for how powerful this book is. Just look at this endorsement from the Oracle of Omaha himself. When Warren Buffett says he is an eager reader of your work, well, that's about the best seal of approval you can possibly get. You know right away this isn't just some dusty old book on a shelf.
And this dedication? It just sets the perfect tone. Right from the get-go, Fisher tells you who this book is for and who it's not for. He isn't writing for the herd. He's talking to the independent thinkers, the ones who question the crowd. If you're someone who likes to think for yourself, this is basically your playbook.
So what was Fisher's big revolutionary idea? Well, he had this fantastic concept he called the Scuttlebutt method. And trust me, for the time, this was a totally radical way to think about analyzing a company, going way beyond what everyone else was doing.
To really get how groundbreaking this was, you have to remember what investing was like back then. Pretty much everyone was obsessed with the numbers, the balance sheets, the income statements. Fisher comes along and says, hold on, the story, the qualitative stuff, that's where the real secrets are. He basically told people, forget being an accountant, you need to be a detective.
So what exactly is Scuttlebutt? Think of it like gathering intelligence. It's all about building a complete 360-degree picture of a business by talking to a whole network of people. It's how you get the real scoop, the unofficial story, the kind of stuff you will never, ever find in an annual report.
And look, this isn't some vague, abstract theory. He laid out a real boots-on-the-ground process. He's talking about actually picking up the phone and talking to a company's customers, finding ex-employees to get a real sense of the culture, even grilling their competitors to find out what they're really good at and what they're not. It's essentially creating your own private intelligence network. The crazy part? This is what the world's biggest hedge funds do today, and Fisher was writing about it in 1960.
But Fisher wasn't just a genius for creating this method. The really wild part is how he used it to see the future. This book isn't just a guide, it's like a time capsule. When you read the predictions he was making back then, it's almost spooky.
Just take a look at this. In 1960, he's saying inflation isn't just some temporary blip, it's going to be a persistent problem. And get this, he warned that when central banks jack up interest rates, it could actually make inflation worse sometimes. Sound familiar? He was railing against these big, unfocused mergers decades before everyone else realized they were a bad idea, and he saw that technology would be the ultimate engine for growth. The guy's vision was just on another level.
His ideas map perfectly to the world we live in now. What he called mergers for lateral diversity, today we call that diversification. The conglomerate craze he warned about became a textbook example of companies destroying value. He was fighting against bad management long before poor corporate governance became a catchphrase. It just goes to show you the fundamentals never really change.
Okay, so to really hammer his ideas home, Fisher tells this great story about a made-up company he calls Pioneer Metals, and it's just a perfect little masterclass in how a totally mediocre business can transform into a legendary investment.
So, picture this. Pioneer Metals starts out as this completely forgettable, dead-in-the-water company. The stock's a dog, nobody wants it. But then, a new leader comes in, a true visionary. He totally overhauls the company, pushing it into these super complex alloys for high-tech industries. He brings in the best people and turns it from a nobody into an absolute powerhouse.
So what was the result? What happened to the stock after this amazing turnaround? It went up, wait for it, 4,000%. A 40-bagger in just a decade. And here's Fisher's main point. This had nothing to do with luck or a hot market. This was 100% about the impact of brilliant, visionary leadership.
Now, okay, Pioneer Metals wasn't a real company. Fisher made it up to illustrate his point. But, and this is so important, the story itself is completely real. This exact pattern has played out time and time again. Think about Nucor, going from near bankruptcy to dominating the steel industry, or Hewlett-Packard and Texas Instruments, real companies that were transformed by incredible people. The name was fictional, but the formula for success? Absolutely real.
And this quote just says it all, doesn't it? For Fisher, it always came down to the people in charge. Now, was he being mathematically precise with 90%? Probably not. but his message is loud and clear. If you find an outstanding management team, you've found almost everything that matters. Everything else is just noise.
All right, so after all that, what's the one big thing you should really take away? How do we boil all this incredible wisdom down into something you can actually use? Well, luckily for us, Fisher's son, Ken, did it for us, distilling his dad's whole philosophy into a single essential question.
And there it is. This one question. This is the whole game. This is the heart of the Scuttlebutt method. It's the lesson from the Pioneer Metals story. It cuts through everything. It's not just about what a company is doing well. It's about what they're doing that is unique. And that tiny little word, yet, that's everything. It means they have a head start and everyone else is just playing catch-up.
So we'll leave you with that challenge from Fisher. The next time you're thinking about making an investment, ask yourself, what am I really buying here? Am I just playing with ticker symbols on a screen, reacting to the news? Or am I doing the real work, the Fisher way, to find a business that's doing something special its competitors aren't doing yet? Because as Fisher showed us, that one little word can be the difference between a decent investment and a truly great one.
Hey, welcome. Today we're going to do something a little different. We're jumping back to the 1960s to look at some amazing writing that totally flips a common investing belief on its head. And you know what? A lesson from way back then might be just the thing we need to hear right now.
So, let me just ask you straight up, is your portfolio truly inflation-proof? I mean, really? It's the kind of question that can keep you staring at the ceiling at 3 a.m., right? And the answers you usually hear? Well, they might not be the ones you need.
You've probably heard this a million times. The common wisdom is, hey, stocks represent ownership in real stuff. Factories, machinery, inventory. So they have to be a natural hedge against inflation. I mean, it makes sense, doesn't it? As the dollar gets weaker, the value of all that stuff should go up. It sounds so logical, but as we're about to find out, it's a dangerously simple way of looking at things.
Okay, so here's how we're going to break this all down. First, we'll bust the great inflation myth. Then, we'll get into why inflation is pretty much inevitable. After that, we'll tackle some of the fears that drive the market crazy, find out what a real inflation hedge actually is, and wrap up with a warning that honestly feels like it was written yesterday, not decades ago.
All right, let's dive right in. Section 1, the great inflation myth. So back in the late 1950s, this idea took hold that any stock was a good stock if you were worried about inflation. It caused this total market frenzy. But the author we're looking at says, hold on, this whole thing is built on a massive misunderstanding of what inflation even is.
So first things first, let's make sure we're all talking about the same thing. Forget all the complicated jargon and economic models for a second. The author's definition is just so simple and perfect. Inflation is just your money buying less and less over time. That's it, plain and simple. And for an investor, that's really the only definition that counts.
Okay, but why does our money seem destined to lose value? This is where it gets really interesting. The author points out something that feels a bit counterintuitive. The seeds of inflation, they're not sown when times are good. Nope, they're planted when the economy takes a nosedive.
And this quote right here, this is the heart of the whole argument. It's not about spreadsheets or market cycles in the way we usually think about them. It's about what we expect. The public, we demand that the government does something to stop a major depression from happening. And that one simple, deeply held belief kicks off a chain reaction that's incredibly predictable.
And check this out. This cycle is just so clear. When business hits a slump, what happens? Tax money coming in plummets. But at the exact same moment, government spending shoots up, things like unemployment benefits. So to stop a full-blown crisis, the government has to spend way more than it's making. You get these massive deficits. And that deficit spending, well, that's literally new money getting pumped into the system, and that is inflation. It's almost like an automatic built-in feature of the economy.
So because people don't really get where inflation comes from, they start making decisions based on fear. And the author zeroes in on two big mistakes, two fallacies that investors make. The first one is this terror that inflation is some kind of monster that's just going to get faster and faster until it's totally out of control.
Yeah, this really shows the gap between what people fear and what's real. Investors picture this horse just breaking into a full-on runaway gallop, right? They imagine everyone hoarding stuff, which just makes prices spiral. But the author's like, no. The reality, at least in the US, is way more like a slow, leisurely stroll. It's driven by that same predictable cycle we just talked about, deficits during bad times. And why don't we see that crazy hoarding? Well, it's simple. It costs a fortune. Think about it. If you're a business, you've got to pay interest on the money you use to buy all that inventory. You've got to store it, insure it, pay taxes on it, and that's before you even think about the risk of it spoiling, getting damaged, or just becoming obsolete. All those costs are like a huge brake pedal on the economy, stopping that runaway stockpiling from ever really getting started.
And if you look at the numbers from back then, they totally support this. For all the freaking out about inflation in the 1950s, the average was just about 2% a year. Now, don't get me wrong, that definitely eats away at your wealth over time. But it's not the crazy, out-of-control spiral everyone was scared of. And what that means is you don't have to panic and just buy anything you can get your hands on.
Plus, there's this other huge force working in the opposite direction. It's a counterbalance to inflation. Yeah, wages go up, pushing prices up, but at the same time, you have this amazing engine of innovation, what the author calls the industry of discovery, that's always finding ways to make things cheaper and better. Just think about a car tire today versus one from 30 years ago. It might cost about the same in dollars, but it lasts so much longer. It's so much safer. In real terms, the price has plummeted, and that's happening everywhere.
Okay, this is where we get to the real heart of it all. If the old rule book is wrong, if just owning things isn't the answer, then what is? What's the actual way to protect yourself and, more importantly, grow your wealth when your money is buying less and less every year? The author comes up with this just perfect analogy that you'll never forget. Picture this. It's Germany in the 1920s. Hyperinflation is raging. You think, I know, I'll protect my money by buying things. So you buy a warehouse full of bustles. You know, those fashion things from the 1890s? You own a ton of stuff, but guess what? It's completely worthless because nobody wants it. It's such a great illustration that the value isn't in the object itself, it's in whether people actually want or need it.
So that's the million-dollar question, right? If the value of a company's assets on paper isn't what drives its stock price, and we all know it isn't, then what does? What's the real engine behind a great stock?
And here it is, the big reveal. The one and only true hedge is earning power. It's about owning a piece of a business that is so darn good, so innovative, so well run that it can grow its profits every single year and grow them faster than inflation is eating away at the dollar. That's it. That's the only real protection you have.
What's wild is that inflation actually works like a secret tax on just, average companies. Think about it. Prices go up, so they need more cash just to have the same amount of stuff in their warehouse. Their customers start paying slower, so more cash is tied up waiting for payments. And here's the kicker. When a big piece of equipment finally breaks down, they can only write off what they originally paid for it, not the new, much higher price to replace it. It's just this constant, slow bleed that chips away at the value of an average business.
Which brings us to our last section. And this is a warning, straight from the past, that honestly feels like it could have been written this morning. The author saw firsthand how a popular idea, even a totally wrong one, can make people do really dangerous things in the market.
And that's precisely what was going on. This massive inflation phobia swept the nation. Investors, a lot of them brand new to the game, just abandoned bonds and poured into stocks. Not great stocks, not good stocks, just any stock. They thought it was some kind of golden ticket to safety. Of course, this herd mentality just drove prices for all kinds of companies up to levels that made no sense.
The way the author describes these impatient investors is just perfect. He says they're like somebody who goes outside to watch the moon. They stare at it for 4 minutes, and because they can't see it moving, they get disgusted and go back inside. They completely miss the huge, spectacular change that happens over the next few hours. Inflation is just like that. It's slow, it builds up over time, and investors who want a quick win often give up on the right strategy right before it was about to work. So what can you actually do with this information? Well, the advice is to pay attention to the big picture. When you see interest rates going up and money getting tight, you should probably be a bit more careful, a bit more picky. A downturn could be coming. But on the flip side, after you've been through a long stretch of that economic pain, that's when you should be getting more excited about owning the right stocks, because you know the government is going to have to switch gears, and that will kick off the whole cycle again, making those truly great companies even more precious.
Look, if you take away only one single thing from all this, make it this sentence right here. Stop looking for an inflation hedge. Start looking for an outstanding business. And the real acid test is this. Would this company still be an amazing investment if inflation didn't exist at all? If you can honestly say yes to that, well, you found your answer. And so I'll leave you with this final thought. Back in the 50s, the herd ran toward any common stock.
Today, investors are running towards a whole new set of assets they think are inflation hedges. So the real question for you and for me is, are we just following the herd again? Or are we actually using this timeless test and focusing only on real, lasting earning power? It's definitely something to think about. Thanks so much for joining me.
Welcome to The Explainer. Today, we're digging into a powerful force that completely reshaped the stock market after World War II, a force that honestly still explains so much about how markets behave today. We're gonna uncover a fundamental shift in the very mechanics of supply and demand for stocks. Okay, so let's jump right in. We usually think of the market as this perfectly balanced tug of war, right? You've got countless individual buyers on one side, countless sellers on the other. But what if a new, absolutely massive player stepped onto one side of that rope and just never left? What if they permanently tilted the scales? So here's how we're going to break it down. We're going to start in the 1930s, a market with a strange structural weakness. Then we'll meet this new, unseen force and see how it created this exclusive club of premium stocks. And most importantly, we'll figure out what it all means for you as an investor today. Let's set the stage here. The change we're about to explore wasn't just some passing trend or a shift in sentiment. No, this was a deep structural transformation of the entire financial landscape. It was all driven by the arrival of a new and unbelievably powerful type of buyer. But to really get why this was such a revolution, we first have to understand the world it replaced. So let's hop in our time machine and go back to the 1930s, a decade that was defined by a lot more than just the Great Depression. Okay, so the first 2 points here, that's pretty common knowledge. You had a struggling economy and a whole lot of political uncertainty. But our source material points to a third kind of hidden force at play. You see, estate and income taxes were incredibly high, and this created this relentless, constant pressure. Whenever a wealthy stockholder died, massive blocks of their shares had to be dumped on the market just to pay the tax bill. It was a constant flood of supply. And here's the crucial point. The pre-war market had this built-in downward bias. The same taxes that forced all this selling also made it harder for the wealthy to save and buy more stocks. There just wasn't enough new money coming from the traditional buyers to soak up all the shares being sold. The scales were basically stuck, pointing down. That is, until a completely new kind of buyer showed up. After World War II, the entire equation just got flipped on its head. That constant downward pressure was replaced by an even more powerful, persistent upward pressure. And it was all thanks to the rise of what we call the institutional buyer. And this wasn't just one group, you see. It was this five-front wave of new capital. What's really fascinating is where a lot of this money came from. Pension funds, for example, were funneling the savings of millions of factory and office workers, people who historically had never been major players in the stock market, directly into equities. And the scale of this change, it was just staggering. I mean, think about the speed of this growth, a 20-fold increase in private pension money in just 2 decades. This was a tidal wave of new cash, and it was all looking for a place to go. And more, that place was the stock market. And it's not just that these funds were getting bigger, they were also getting much more aggressive. In just 7 years, the percentage of their money they put into common stocks more than doubled. This shows a huge strategic shift, a growing belief that owning stocks for the long haul was not just respectable, but necessary. This trend went way beyond just pension funds, too. You had bank trust departments, the folks managing money for wealthy individuals, and they were all in. By 1959, over 60% of their assets, we're talking more than $30 billion, was in common stocks. The appetite for stocks was absolutely massive, and it was everywhere. And this slide right here, this illustrates the key mechanical difference. This wasn't individuals trading in and out. Institutions were buying stocks to hold for years, maybe forever. They were taking shares out of the day-to-day market, locking them away, and fundamentally changing the supply and demand balance. It was a one-way street that pushed prices up. But, and this is a huge but, this massive wave of money didn't lift all boats equally. Not even close. This institutional demand was incredibly focused, highly concentrated, and it created a new, exclusive, and very expensive club of stocks. So why the focus? Well, it happened for 2 main reasons. First, you've got just plain old economic common sense. Institutions wanted the biggest, safest, best-run companies. But the second reason is even more powerful. It's legal. Trustees have to follow something called the prudent man rule. To avoid getting sued if things go south, the safest move is to just buy the same big popular stocks that all the other respected trustees are buying. As one person cynically put it, it is all right to lose heavily as long as you do it in good company. This dynamic created this powerful phenomenon that our source material calls institutional acceptance. Think of it like getting accepted into a super exclusive club. Once a company gets that seal of approval, it becomes the target for a relentless, never-ending stream of buying from all 5 of those institutional sources. And the author uses this absolutely brilliant analogy to explain what happens next. Gaining institutional acceptance is like being put on a pair of very high stilts. These companies are lifted to a permanently higher price level, a higher price-to-earnings ratio, than other perfectly good companies that just don't have that accepted status. Now, this new market structure, this world of stocks on stilts, created this really unique and powerful opportunity for the sharp individual investor. So why does all this matter to you? Because it lays out a clear path to what the author calls a double profit. The strategy itself is beautifully simple in concept. It's not about buying the stocks that institutions already own, the ones that are already way up on those stilts. No, it's about finding the next great company and buying it before the institutions show up, basically predicting which company is about to get lifted onto those stilts. Okay, let's walk through the math here because it's just incredibly powerful. Say you buy a great but still under-the-radar company. It's earning $2 a share, and the market values it at a pretty modest 12 times earnings. So you pay $24. A few years go by, the company does great, and its earnings double to $4. Now, based on that alone, your stock should be worth $48. But now the institutions have noticed. They give it acceptance, and suddenly the whole market is willing to pay 24 times earnings for it. So now your $4 of earnings gets multiplied by 24, and the stock price jumps to $96. Your investment has quadrupled. And that is the double profit. You see, you capture 2 completely separate sources of return. First, you get the profit from the company's own fundamental business success, and second, you get the profit from the change in perception as the market re-rates the stock to a permanently higher valuation, all because it's now up on those institutional stilts. Of course, a strategy this powerful doesn't come without risks. Living life up on stilts gives you a fantastic view, but it also introduces a very unique kind of danger. So let's look at the other side of this coin. Here's the trade-off. As long as that company stays excellent, it stays up on those stilts. Its price grows right along with its earnings, just from a much higher starting point. But if the company's quality starts to slip, maybe management gets lazy or its industry hits a rough patch, the stilts rot. And the fall is absolutely spectacular because it gets hit with a double whammy. Its profits go down and it loses that premium valuation. The stock doesn't just fall, it crashes back down to earth. So what's the big lesson here? It's that these principles are totally timeless. First, you have to understand the major forces that are shaping the market you're actually investing in. Second, recognize that any kind of concentrated buying always creates these price premiums, these stilts. The real money, then, is made by anticipating where that buying is going next, not just chasing it. And finally, always remember, the safest stocks can become the most dangerous if that premium valuation is no longer justified. And that leaves us with one last big thought. This analysis was brilliant at identifying the huge market-shaping force of the 1950s and 60s. The question for all of us, as investors right now, is this. What are the modern equivalents? What are the new, powerful, concentrated buying forces that are creating the invisible stilts in today's market? That's what we should all be watching for.
Let's travel back in time for a second. Imagine it's the early 1960s. For what feels like the first time in a generation, American economic dominance, well, it suddenly feels a little fragile. The threat of foreign competition is no longer some abstract idea. It's very, very real. And for investors, this brings up a huge question. Where do you actually put your money when all the old rules don't seem to apply anymore? Today we're going to dig into that exact dilemma by exploring a really fascinating moment in financial history.
So, here's how we're going to break this all down. We'll start with America's big wake-up call. Then we'll look at a couple of popular, but as we'll see, pretty flawed investment ideas. From there, we're going to uncover some hidden psychological risks. And finally, reveal what our author saw as the one true path to safety. It all ends with a look at a nation standing at a major crossroads.
All right, first up, America's wake-up call. So where did all this anxiety come from? This wasn't some slow, gradual decline. It was a sudden, almost jarring shift in the whole national mood, like a deep crack suddenly appearing in that armor of post-war confidence. And maybe the most shocking part was just how fast it all changed. Before 1957, most Americans were, as the author puts it, pretty much smug about their economic dominance. But then, almost overnight, that confidence just shattered, and it was replaced by this widespread sense of alarm.
Now, this wasn't just some vague feeling. It was driven by cold, hard facts. A serious business slump started to hit. Gold was literally flowing out of the country's vaults at Fort Knox, and all of a sudden, you started seeing those once exotic foreign cars everywhere on the roads. That old, comfortable belief that American know-how could always beat cheaper foreign labor was being seriously questioned.
And this quote right here, it just perfectly captures the dilemma that every smart investor was grappling with. See, it wasn't just about picking winners anymore. It was about making sure you didn't get dragged down by this powerful new economic tide. This fear sent investors scrambling for new strategies, and the first place they looked was, well, pretty obvious.
Which brings us right to our second section, the allure of foreign stocks. The thinking was pretty simple. If you can't beat them, join them. So investors started looking overseas, hoping they could profit by just buying shares directly in these up-and-coming foreign companies.
But, this path was absolutely riddled with problems. I mean, how do you really investigate a company that's thousands of miles away? You're dealing with language barriers, completely different accounting standards. It's a mess. And on top of that, in markets that are less liquid, even a small trade could send the price plummeting. It was a whole lot riskier than it looked on the surface.
Okay, so if buying foreign stocks directly was just too much of a headache, investors started looking for a clever workaround. And this led them to a second big strategy, what the author calls the multinational corporation trap. Just invest in good old American companies that were setting up their own factories overseas.
And you can see why this was so appealing. The logic was incredibly seductive, right? You get the best of both worlds. You've got cheap foreign labor making the products, combined with that proven American management running the show. On paper, it looked like a foolproof recipe for massive profits.
But whenever something seems that perfect, you gotta ask the question. And the author poses a crucial one here. Could there be a hidden risk? Is there a trap that all these excited investors just aren't seeing?
And the answer to that question reveals the trap. Turns out, the biggest risk wasn't economic at all. It was political. And this brings us to the psychology of nationalization, that deep, unpredictable danger of a foreign government just deciding to take everything away.
The author points to a really stark and at the time very current example, Cuba. Here's a country that for a long time was a close friend to the US, but then things changed, and suddenly massive American investments there were worth basically zero, overnight. This wasn't some theoretical risk, it was real, and it was happening right then.
The psychology behind this is so important to understand. The author uses this great analogy. Think of a family. It's almost always the rich member of the family that the others envy, and maybe even dislike a little. To much of the world, America was that fabulously rich family member. And those corporate plants, they were the symbols of that wealth, making them a natural target for local resentment and opportunistic politicians. And the author argued this risk was only going to get bigger. You had this tidal wave of U.S. investment creating a temporary boom, and that's great while it's happening, but what happens when the building stops and the profits start flowing out of that country and back to America? What happens when a recession hits? That goodwill could evaporate really, really quickly.
So, if buying foreign stocks is too tricky, and investing in U.S. companies abroad is way too risky politically, is there any safe place for an investor to go? Well, the author believed there was one sure way.
And the answer wasn't about finding cheaper labor, it was about being smarter. The real key was to invest in U.S. companies that were the absolute, undisputed technical leaders in their fields. Companies making things that literally no one else could.
But hold on a second. It's a great question, right? Couldn't a foreign competitor with cheaper engineers and lower research costs just out-innovate the American company and take the lead? It's a totally fair point, and the author has a very specific answer.
See, the core of the strategy isn't about being permanently, magically superior. It's about building a culture of constant innovation. The goal is to create this dynamic where, by the time your competition finally copies the product you're making today, you've already invented and are selling tomorrow's product. They are always one step behind.
This whole approach gives investors this powerful three-layered shield. First, it pretty much makes your company immune to price competition. Second, it opens up huge new export markets for your superior products. And third, and this is so critical, it gives you powerful leverage against that political risk we were just talking about.
Now, to really drive this point home, the author uses a chillingly powerful historical analogy. They point out that even in one of the most hostile regimes imaginable, having an indispensable technical skill could provide a unique form of protection. The takeaway is clear. If a nation needs what only your company can make, they are far, far less likely to just confiscate it.
So for our last section, A Nation at a Crossroads, the author kind of zooms out. This isn't just about individual stock picking anymore. It's about the future path of the entire American economy.
This slide lays out the two potential futures, the two paths America could take, as seen from the 1960s. Path 1. If America could control its costs, keep wage growth in line with other countries, and get rid of feather bedding, which are basically inefficient work rules requiring more workers than needed, then it could stay competitive. But Path 2, if not, the author predicted some real economic pain and high unemployment.
But what's so fascinating is the author's honesty here. Writing in that moment, they basically admit, I have no basis for predicting which way this will go. They genuinely didn't know which path the country would take. It all seemed to hinge on the quality of national leadership that had yet to emerge.
And that leaves us with a final question for today, one for us to think about. Looking back from where we stand now, with decades of hindsight, which path did America ultimately choose? And maybe more importantly, are we possibly facing a similar kind of crossroads today? Definitely something to chew on. Everyone, and welcome to The Explainer. So today we're diving into a really powerful idea, one that basically defined an entire decade. It's this belief that a booming population automatically leads to a booming economy. And it kind of makes sense, right? More people, more spending, more money. But what if that simple math is just wrong? Let's get into it.
It all really kicks off with this one phrase, the Golden 60s. Now, this wasn't just some catchy nickname. It was a promise. It was this heavily pushed idea that the next decade was, destined for this incredible economic boom, and it was all going to be powered by one simple, unstoppable force, a whole lot more people.
So here's how we're going to break it all down. First, we'll unpack that Golden 60s promise. Then, we're going to look at the simple, optimistic case for a boom before getting a much-needed reality check from the cynics. From there, we'll find the middle ground, figure out what the real challenge is for an investor, and finally put this whole population idea in its proper place.
Okay, so let's set the stage a bit. Coming out of the post-war era, there was this really widespread belief that the massive surge in population, well, it wasn't just a demographic trend. No, it was a one-way ticket to economic success. It was sold as this guaranteed story of prosperity.
And this idea was everywhere. The logic felt really solid. The sheer number of new people was going to act as this powerful, positive force for investment, for growth, for everything. It was a really compelling story that directly linked the baby boom to a coming golden age of business. But what was really behind that rosy picture?
Well, the optimistic argument was honestly beautifully simple. More people means more consumers. More consumers means more spending. And more spending leads directly to more economic growth. You can see why it was so appealing. It's just a really straightforward and powerful chain of events.
And this just lays out that step-by-step thinking perfectly. First, you've got this huge wave of post-war babies growing up into teenagers. All of a sudden, boom, there's massive new demand for cars, for more expensive clothes, for travel, all the stuff young adults want. Then, that same group starts forming families of their own. And that creates an even bigger wave of demand for homes, furniture, appliances, the works. With birth rates staying high, it just looked like a compounding effect, a guaranteed, ever-growing prosperity. It seemed totally unstoppable.
But of course, that's when the cynics step into the room with a pretty sharp reality check. And they ask a simple but really powerful question. If more people automatically create prosperity, well, why isn't that true for every single country on the planet?
And right here, that's the core of the counterargument. Look, if a bigger population was the magic key to wealth, then countries like India and China would have been the most prosperous nations on Earth. The thing is, this new, younger generation, they're mostly spending money, not earning it yet in high-paying jobs. So the real question is, where does that spending money actually come from?
So this is the fundamental conflict right here. The optimist sees more people creating new demand, making the entire economic pie bigger. But the cynic? They see a family's income as a fixed pie. That extra money spent on a teenager's car has to come from somewhere, which probably means less spending by the parents on their own stuff. So in that view, the total volume of business doesn't really grow. The money just gets shifted around. And if you've got more mouths to feed from that same pie, the overall standard of living actually goes down.
So we're left with two completely different predictions. On one side, you have a guaranteed boom, and on the other, a declining standard of living. Which one was it going to be?
Well, as you've probably already guessed, in a complex economy like this one, neither extreme view really tells the whole story. The truth, as it so often is way more nuanced. And it's somewhere in the middle. The pessimists are definitely right that you can't just create wealth out of thin air.
But here's the counterbalance. People and families, they adapt. They can actually increase their income when the pressure's on. You know, wives who might have stayed home take on jobs, adding a second income. Husbands, driven by that greater need, work harder for a promotion or take on extra hours. And of course, as teenagers get older, they join the workforce themselves and start contributing. So all of this creates a degree of new wealth, some genuine production. It's not the wild boom the optimists promised, but it's enough to stop that sharp decline the cynics were worried about.
Okay, now this is where things get really important, especially if you're thinking like an investor. Focusing on whether the overall economy grows by a couple of percentage points, well, that's actually kind of misleading. It's really the wrong way to look at the problem.
And the reason is pretty simple. You don't invest in the economy, you invest in specific individual companies. So sure, the total market might get bigger, but so does the competition. You'll have more businesses all fighting for a piece of that market. So what really matters isn't the total amount of money being spent, it's where that money is going.
And that's the absolute key. The most significant effect of all this population pressure isn't the overall growth, but the massive and frankly unpredictable shift in spending habits. As family budgets get tighter and get rearranged, money flows away from some industries and towards others. Some companies are going to win big from this, while others are going to really struggle.
Which brings us to the core challenge, the million-dollar question really. When a family suddenly has to account for the growing needs of their kids, how do they make those tough choices? How do they decide to juggle their spending?
And this is where it gets just fascinatingly complex, right? Is a family going to give up repainting the house so they can buy a car for their teenager? Or will they try to do both, but maybe switch to a cheaper car model or buy a used one instead? Will they start serving more spaghetti and less steak for dinner? I mean, the number of choices is just staggering. And then you throw in a wild card, like some new technology that suddenly makes a TV or a dishwasher way cheaper than anyone expected. It's chaos.
So, trying to predict these millions of individual family decisions across an entire country, yeah, that is, to be blunt, a fool's errand. The much wiser strategy, especially for an investor, isn't to try and guess what's going to happen. It's to simply observe what is happening right now and then make some reasonable judgments about whether those trends are likely to continue.
So let's bring this all home. While population changes definitely have an effect on the economy, this idea that it's some simple, all-powerful engine of guaranteed prosperity, that's a major oversimplification. Its influence has been put on a pedestal that, frankly, it might not deserve.
In the end, the source material gives us a really clear verdict. This whole idea of population change, which was one of the main things holding up that golden 60s concept, it's just been overstressed. It's a piece of the puzzle, for sure, but it is not the whole picture. And its real effects are way more complex and unpredictable than that simple story would have you believe.
And that really brings us to our final thought. The story of the golden 60s is such a powerful lesson in questioning these simple, easy economic stories we're told. It leaves us with a really crucial question to think about. What popular, seemingly certain economic truths? What stories about guaranteed growth or guaranteed decline are we overstressing today?
Today, let's talk about a really fundamental shift in how we should think about investing. We're going to move away from the old idea of gazing into a crystal ball to predict the economy and step into the much more fascinating and, frankly, way more useful world of human psychology. Okay, let's get into it.
So for decades, this was pretty much the question, wasn't it? The whole financial world was built on the belief that if you could just figure out where the economy was going next, you had the master key to making money. But what if that entire idea is just wrong now?
So here's how we're going to break it all down. First, we'll look at the forecaster's flaw. Why prediction just isn't the name of the game anymore. Then I'll introduce you to a really cool mental model called the captive balloon theory. From there, we'll see how to actually use it to figure out when to buy stocks, explore the mind games and psychological traps we all fall into, and then wrap it all up by looking at what this means for investing in the future.
You know, for the longest time, The Economist was the star of the show. Their forecasts were treated like gospel when it came to making investment decisions. But the world has changed in some pretty big ways, and relying on those old methods today, well, it can be a recipe for disaster, or at least for missing some huge opportunities.
Back in the 1940s and well into the 50s, the playbook was beautifully simple. It was basically this: if the economy looks like it's growing, you buy. If it looks like it's shrinking, you sell. And you know what? It made a lot of sense back then, because the stock market was tied to the economy in a very direct, very straightforward way.
So what changed? Why doesn't that simple rule work anymore? Well, the economy of the past was just a lot more fragile. The banking system was weaker, and our industrial base was way narrower, which meant recessions hit everything, and they hit hard. Today's economy is a completely different beast. It's incredibly complex and diverse, with government backstops and different sectors that kind of balance each other out. The whole system is less predictable, for sure, but it's also much less likely to just completely fall apart.
And this right here, this number illustrates the new math for every investor. Look, a bad recession might knock your stock down 35, maybe even 50%. And yeah, that hurts. No one likes that. But finding the right company, a real innovator, can lead to gains of hundreds or even over 1,000% in a decade. So the takeaway is huge. The potential reward for picking a great company is just so much bigger than the temporary risk of a downturn you couldn't predict.
And hey, don't just take my word for it. This quote is a big deal. By the late 1950s, the economists themselves were starting to throw in the towel. They were admitting out loud that they were losing faith in their own predictions. They realized their real value wasn't in forecasting the future, but in understanding the present.
Okay, so if the economic crystal ball is broken, what do we use instead? Well, this brings us to a really powerful psychological model. I want you to think of this as a new way to visualize what's really going on with a stock's price. This constant tug of war between what a company is really worth and how the market feels about it. First, we have to nail down this concept of intrinsic value. Now, this isn't some vague, fuzzy idea. It's the real, honest-to-goodness worth of a business. It's based on things you can actually measure, like its ability to make money and what its future looks like. You can't calculate it down to the last penny, but it acts as the fundamental anchor for a stock's price.
All right, let's start building this metaphor in our minds. First, picture that intrinsic value as a line that's moving through time. For a really good, growing company, this line is always climbing upward as the company makes more money and its future gets brighter. This line, this is reality. Okay, now for part two. Imagine the actual stock price, the number you see ticking up and down all day as a balloon. But here's the key. This balloon is tied to that line of intrinsic value with a string. It's not just floating away randomly, it's always tethered to the reality of what the company is actually worth. And here's where the psychology kicks in. Think of investor emotion as the air that fills the balloon or lets it out. When everyone gets swept up in hype and enthusiasm, the balloon gets pumped full of hot air and floats way, way above that line of true value. But when fear and pessimism take over, the air rushes out and the balloon sinks, sometimes way below the line.
Now, this is the most important piece of the whole puzzle. That string always holds. It doesn't matter how crazy or euphoric or terrified the market gets, the balloon, the price, can never escape that line of intrinsic value forever. Sooner or later, reality always pulls it back. The price will always, eventually, move back towards its fundamental worth.
So, this theory is cool and all, but how do we actually use it to make better decisions? This is where we go from theory to practice. The captive balloon theory is basically our guide for one of the toughest decisions an investor has to make. Not just what to buy, but when to buy it. So here's how you should think about it. You need to separate two very different jobs. Analyzing a company's fundamentals, its management, its growth potential, all that stuff. That tells you what companies are worth owning. That's business analysis. But understanding psychology, judging whether that balloon is flying way too high or sinking way too low, that's what helps you decide when is the right time to make your move. Let's look at a classic example you see all the time. A great company announces some amazing new product. Phase 1. The news breaks, everyone gets excited, and the stock price shoots up. But then comes phase 2, the wait. It takes months, sometimes years, to actually build the factories and start making money. Impatient investors get bored, that initial excitement fades, and the stock price drifts down. Finally, phase 3. The profits start rolling in and the price takes off again. The smart investor, the psychologist, sees that sag in the middle not as a problem, but as a perfect buying opportunity created by totally predictable human impatience.
You see, the market isn't just companies and numbers. It's a game being played inside millions of human minds. And the tricky part is, our minds have all these built-in glitches and biases that often lead us to make bad decisions. There was this incredible experiment back in the 1950s that gives us a perfect look at these common and very costly mental traps.
So here was the setup. A professor named O.K. Burrell gave 40 students some play money and a list of 6 totally imaginary stocks. And this is the key detail. The students knew nothing about the companies. There were no stories, no products, no celebrity CEOs. All their decisions had to be based purely on the numbers.
All the professor did was change the prices every now and then and tell the students to do their best. What this did was isolate one of the most powerful psychological forces in all of investing, our emotional reaction to a price just going up or down.
And the results? Well, they were fascinating and honestly, completely predictable. The students made all the classic mistakes. They averaged down, buying more of a stock just because it got cheaper. They sold their winners way too soon to lock in a small profit. And on the flip side, they held on to their losers for way too long, just hoping they'd break even. And the root cause of all of it was this thing called price fixation. Their brains got stuck on the price they first paid, and they couldn't see the stock's real value anymore.
Now, it's really easy to just dismiss this and say, well, they were just college students. What do they know?
But here's the kicker. When you talk to experienced stockbrokers, they'll tell you that the vast majority of their real clients make these exact same mistakes, day in and day out. These aren't rookie errors. These are human nature errors.
So after all this, where does that leave us? Well, it points to a much clearer path forward for anyone who wants to be a smarter investor. The future of great investing isn't about getting a better economic forecast. It's about developing a much deeper understanding of market psychology and, maybe most importantly, our own psychology.
It really all comes down to this single powerful idea. Look, technology changes, companies change, economies change, but basic human nature, that doesn't change. We are wired to respond to things like hope, fear, greed, and impatience in the exact same ways our grandparents did. The psychological patterns are incredibly consistent. Understanding that is the new edge. And that brings us to the final question, and it's one I want you to really think about. When you look at your own investment decisions, which role are you playing? Are you the economist trying to predict a future that's fundamentally unpredictable? Or are you the psychologist trying to understand the timeless patterns of human behavior to find your real opportunity? The answer to that question might just be the thing that defines your success.
All right, we are about to dig into something that I think really gets to the heart of investing. We're going to look at some fascinating source material that basically takes a sledgehammer to a lot of common beliefs about what makes a stock's price really, truly take off. So let me ask you, what's the one thing that sends a stock into the stratosphere? You might think you know the answer. A ton of assets, massive dividend payments, nonstop stock splits? Well, the source we're looking at today says nope. It argues that these are mostly just noise, distractions from what's really going on. So let's deconstruct these myths, one by one. First up, let's talk about the allure of physical stuff. You know, there's this gut feeling that a company with a lot of factories, a lot of real estate, a big pile of inventory, well, that's got to be a safe, valuable company, right? But this way of thinking can be a serious trap for an investor who's not careful. So let's just lay it out there. Myth number 1. A company's stuff is what makes its stock valuable. It feels so intuitive, doesn't it? I mean, a company with tangible things you can see and touch should be a rock-solid investment. But the reality, according to our source, is way, way more complicated than that. Just so we're all on the same page, when we say asset value, we're talking about everything a company owns. It's the grand total you'd get if you sold off every building, every machine, all the cash in the bank. You might hear accountants call this the book value. It's the value of everything on the company's balance sheet. And here is the absolute key takeaway. Just having a lot of valuable assets is, well, it's just not enough. The source is crystal clear. Unless that company is about to be broken up and sold for parts, having a high asset value on the books will never, by itself, cause the stock price to go up in a big way. Those assets are only as good as the profits they can actually churn out. Now, this is where it gets really interesting, because it's a total paradox. A company with low asset value can be either a huge red flag or a massive opportunity. Think about it. If a company doesn't need much stuff to make a ton of money, but it has no defenses, no patents, no brand loyalty, what happens? Competitors are going to flood in and eat those profits for lunch. That's the danger. But if that same low asset company is protected by a killer brand or some unique technology, it can be an absolute goldmine. And the source really doesn't mince words on this. When you see that combination, big profits but very few physical assets, you have to immediately ask, what's the defense? What's the moat around this castle? And if you can't find a really strong answer, then that low asset value is exactly what it says here, a warning signal. All right, so we moved past physical assets. Let's talk about another thing investors just love to see, cold, hard cash in their pockets. Let's talk about dividends and why they might not be the golden ticket to wealth that so many people think they are. And that brings us right to myth number 2. For literally decades, investors have been taught to chase companies with high dividend yields. It just seems logical, right? The company is paying me directly. But this view completely misses a crucial question. What else could the company be doing with that money? So, why aren't dividends the secret sauce for massive gains? Well, a few things. First, taxes. They take a huge bite out of every dividend check you get. Second, now you've got this cash, and you have to figure out where to reinvest it, which comes with its own set of risks. And maybe most important of all, a truly great company can often take that same money and reinvest it back into its own proven high-growth business and get way better returns than you or I ever could. And this quote from the source just nails it. A dividend might give a stock a little temporary bump, sure, but it has nothing whatever to do with those life-changing, multi-100% gains that build real, lasting wealth. Those gains are fueled by something else entirely. And you don't have to take my word for it. The proof is right there in the history books. Our source points to these absolute titans of industry. For years, these companies delivered incredible returns, not by mailing out huge dividend checks, but by pouring their profits back into research, innovation, and expansion. And their stock prices, they followed that growth, becoming legendary. Okay, let's move on to our third and final myth. This one always gets a ton of headlines and generates so much hype in the media, but according to our source, it's mostly just a sideshow. Yep, I'm talking about stock splits. So the myth is pretty straightforward. A company announces a stock split, and that's somehow a catalyst for growth. The idea is the shares are now cheaper on a per-share basis, which will attract more buyers and push the price up. It sounds like a great story, but really, it's just an illusion of creating value. This slide breaks it down so perfectly. Honestly, a stock split is just like trading a $100 bill for two 50s. Yeah, you've got more pieces of paper in your hand, and each one has a smaller number printed on it, but the total value in your wallet hasn't changed by a single penny. The piece of the company you own is exactly the same size as it was before. Our source is really blunt about this. Sure, a stock might get a little flurry of trading activity right around a split announcement, but over the long run, the split itself has virtually zero impact on the actual future value of those shares. It's financial theater, plain and simple, not a real driver of wealth. So, we've busted 3 huge myths. The source argues pretty convincingly that those incredible, life-changing stock gains, they're not about assets, they're not about big dividends, and they are definitely not about stock splits. And this brings us to the most important part of this whole discussion. This really is the million-dollar question, isn't it? If all these common yardsticks we use aren't the key to finding those truly exceptional companies, then what in the world should we be looking for? Where are the real clues? Now, let's be clear. The source is absolutely unequivocal on one point. The connection between a company's per-share earnings going up and its stock price going up is undeniable. It's the bedrock of all of this. Profits matter. They matter a whole lot. But here's where it gets really, really interesting. The source argues that while profit growth is absolutely essential, it doesn't tell the whole story. It might be the engine, right? But there's another, much more subtle force at work that acts like a massive turbocharger. And we're not talking about some obscure financial ratio you'll find in a textbook. No, this is a qualitative thing, a factor that, according to our source, is constantly overlooked by investors who are just staring at spreadsheets. It's this secret ingredient that explains why two companies with identical earnings growth can have wildly different returns in the stock market. And we're going to end on this powerful idea. The source believes that the reward for understanding this hidden influence is enormous. So what is it? It's the market's growing confidence in a company's future. It's that shift in perception, that change in psychology that causes investors to be willing to pay more and more for every single dollar of that company's earnings. This comes from a company's proven ability to innovate, to build an unbreachable competitive moat, and to convince the world it has the management to keep that growth going for years. It's not just about the numbers, it's about the story behind the numbers. And understanding that story, well, that's the real key. Hey, welcome to our explainer. So today, we are tackling a huge question, maybe one of the biggest in all of investing. What is it that really creates those massive, life-changing returns in the stock market? You know, the kind of growth that truly builds wealth. As you're about to see, the answer is probably not what you're thinking. So to get right to the heart of it, let's just start with a choice. Imagine you have two companies in front of you. On one side, you've got a business that is an absolute cash cow right now. It's pulling in huge earnings, but its future looks a little shaky. On the other side, you have a business with just awful earnings today. I mean, truly terrible. But it just might have a huge future ahead of it. So, which one do you pick? I mean, your gut is probably screaming to go for the proven winner, right? The one with the big, fat, reliable profits. But what we're about to uncover through a really fascinating real-world story is that the greatest returns, well, they often come from the place you would least expect. Okay, so to really bring this idea to life, we're going to look at two businesses that could not be more different. First up, an operation that on the surface looks just perfect, a highly profitable medical practice. And then we'll look at what seems like an absolute train wreck, a failing sheet metal plant. So first, let's meet Dr. Smith. This guy is the best surgeon in his entire region, a true artist in his field. And because of that, his practice is an absolute gold mine, raking in $60,000 a year in pure profit, which, for the time, was a staggering amount of money. From the outside, it looks like a machine that just prints cash, and he's even thinking about selling shares in it. But then he goes and talks to an investment banker, and boy, does he get a reality check. The banker points out something crucial. Those amazing earnings are incredibly fragile. You see, the entire business, every single dollar, depended on one man's two hands. If Dr. Smith got sick, or forbid, had an accident, poof, the income would just vanish overnight. There was no management team, nobody being trained to take his place, and really no way for the business to grow beyond him. Because of all that risk piled onto one person, the business was only worth about 2 or 3 times what it earned in a year. All right, now let's do a complete 180 and look at the total opposite end of the spectrum. Jones Sheet Metal. This was, by every possible measure, a truly awful business. I mean, it is really hard to imagine a less appealing company to put your money into. The problems were just endless. The whole industry was full of this brutal, cutthroat competition that basically squeezed profit margins down to nothing. The company was famous for doing shoddy work, it had a terrible relationship with its union, and the owner, this Mr. Jones, well, he was just completely untrustworthy. So when a young guy named Robinson comes along and buys a piece of this mess for 4 times its tiny earnings, his friends all thought he was completely out of his mind. But you know what? Robinson saw something nobody else did. He had a vision. After the original owner passed away, he scraped together the money to buy the rest of the company, took full control, and the very first thing he did was rename it Pioneer Metals. And look, this wasn't just slapping a new sign on the door. This was a loud and clear signal that a new era had begun. This was going to be a complete transformation, from the ground up. So Robinson rolls out this brilliant 4-step turnaround plan. First, he gets them out of the simple, low-profit jobs and pivots into fabricating really complex, high-tech alloys for demanding customers like in the aerospace industry. Second, he invests heavily in building unique skills, becoming the only guy who could handle certain materials that nobody else wanted to touch. Third, and this is the big one, he made unshakable trust the absolute bedrock of the company. And fourth, he started treating his employees not as a cost on a spreadsheet, but as his single most valuable asset. And that third step, that whole building trust thing, well, it got put to the test in the most dramatic way you can imagine. They were working on a massive make-or-break job for a huge manufacturer when his team made a catastrophic mistake, ruining weeks and weeks of work. They were only 4 weeks from the deadline, and failing to deliver wouldn't just be bad, it would completely cripple his client's entire production schedule. Now, legally, he probably could have wiggled out of it, but Robinson felt his word was everything. He told his team to work unlimited overtime, paying for it out of his own nearly empty pockets, to remake the entire order in just 4 weeks. He delivered on time, fully expecting to go bankrupt, but instead, the president of the client's company was so blown away by his integrity that he offered him loans, and even better, he offered him a steady flow of high-margin business. That single act of keeping his word became his best marketing tool. His reputation was now his most powerful asset. And Robinson applied that exact same level of integrity to his own team. See, this wasn't just about winning over customers. It was about building an internal culture of deep, profound loyalty. It was about turning a job into a community where people felt they belonged. And then, tragedy struck. One of his key employees was killed in a car accident while on a company errand. Now, Pioneer had zero legal liability for this. But Robinson immediately went to the widow and set up trust funds to guarantee payment for all 3 of her children's college educations. Word of this incredible act of decency spread like wildfire through the community. Pioneer became legendary as a place that truly stands by its people. And the result? The best of the best, the most talented people in the region, all wanted to work there. And for the first time, a real, durable management team started to form. So there's no doubt Robinson built a fantastic business. Profits grew, which is great. But here's the crazy part. The increase in the company's actual value was way, way more explosive than the increase in its profits. And the reason for this gets at a really powerful concept called the price-to-earnings multiplier. Okay, so let's break that down real simple. The PE ratio is just how much investors are willing to pay for $1 of a company's earnings. A low-quality, high-risk business, that gets a low PE ratio. But a high-quality, dependable, growing business, well, that commands a much, much higher one. So think back to the bad old days. Jones Sheet Metal was a terrible, high-risk business. So investors were only willing to pay about $4 for every $1 it earned. That's a PE ratio of 4. But now, fast forward a decade, after this huge transformation, Pioneer Metals was a superb, high-quality company. Investors saw it as safe, reliable, innovative. So now they were willing to pay $18 for that same $1 of earnings. The PE ratio was 18. I mean, think about that. That's more than a 4-fold increase in the multiplier itself. And right here, this is where the magic happens. Over those 10 years, Robinson managed to increase the company's earnings tenfold, which is an incredible achievement all by itself. But because the multiplier on those earnings more than quadrupled, the total value of his investment grew by a mind-blowing 40 times. So seriously, how is that even possible? Well, let's look at where that insane 40x return actually came from. If you break down the total profit Robinson made, only about a quarter of it came from the actual growth in the company's earnings. A whopping 3/4 of his profit came from the change in that PE ratio, from the market finally recognizing that this was a fundamentally better, higher quality business and being willing to pay a huge premium for it. The key takeaway here is just massive. The biggest gains came from improving the quality of the business, not just the quantity of its profits. Okay, so what were those changes? What are the qualities that make investors suddenly willing to pay so much more for a business? Well, it really all boils down to 3 key pillars of quality. First, it finally had a strong, deep management team. It was no longer a fragile one-man show like Dr. Smith's practice. Second, it had durable profit margins that were protected not by being the cheapest, but by its unique technical skills and its hard-won reputation for being dependable. And third, it had real, clear prospects for future growth because the team had already proven it could innovate and conquer brand new markets. And all of this leaves us with the one big question that sums us all up. When you look at any company, any investment, are you just focused on what it earned last year? Are you looking at its past profits? Or are you looking deeper at the underlying quality of the business that will determine what it's truly worth tomorrow? Because that difference, as we've just seen, is where the greatest value in the world is created. Welcome to The Explainer. Today, we are getting into how those truly massive, life-changing stock market fortunes are really made. You see, it's almost always a 2-part story, but most people, most investors, they only ever see the first part. We're going to focus on that powerful second part. So let me start with a little puzzle for you. Imagine a single company creates 2 totally different fortunes. One early investor walks away with a mind-boggling 12,000% return. A different investor, who came in later, still makes a fantastic 600%. Now, the choice seems obvious, right? But understanding why that 600% gain was even possible, well, that reveals a powerful secret about how the market truly works. So here's how we're going to break this all down. We'll start with the story of these two very different fortunes. Then we'll look at the company's real growth. After that, we'll see what happens when the big money finally shows up and uncover this thing called the price multiplier effect. Then we have to talk about the reality of risk. And finally, we'll see how this exact pattern created some of the biggest giants in American industry. All right, first up, let's set the stage. We're going to use a fictional company from our source material, we'll call it Pioneer Metals, to walk through a very, very real phenomenon. This is the story of two investors who looked at the exact same company, but through completely different lenses. I mean, just look at the staggering difference here. The early backer who was in it for over 20 years saw a 12,000% gain. Just wild. But the public investor who bought in a whole decade later still walked away with an incredible 600% gain. These numbers are worlds apart, which really begged the question, why on earth would anyone knowingly choose the smaller, later return? So how did that 600% gain even happen? To get it, you first have to look at the engine of the company itself. Because this wasn't just random market hype. It was all built on a foundation of real, fundamental business growth. You see, the management team at Pioneer was just brilliant. They didn't just do one thing well. They completely mastered a niche, and then they used that expertise to find and fund new cutting-edge ventures. But here's the crucial part, the thing that made them so special. They were incredibly disciplined. They would only raise new money if it was actually going to increase the earnings for every single share out there, not water it down. And what was the result of that super sharp strategy? Well, this. In the 10 years after Pioneer went public, the company's per-share earnings shot up by 300%. So that's the first piece of our 600% puzzle. The company literally became 3 times more profitable for every single shareholder. But hang on a second. A 300% growth in earnings, that doesn't equal a 600% return on the stock. So where did the other half of that massive gain come from? Well, this is where a new and incredibly powerful force enters the story. As Pioneer grew and really started proving itself, it got on the radar of the heavy hitters, the big financial institutions. We're talking about huge investment trusts, massive pension funds, and the trust departments of major banks. You know, the organizations that manage these enormous pools of money. So why did they wait? Because these giants, they have a very specific checklist. Back in the early days, Pioneer was just too small, too risky, too unproven. But by the time our public investor bought in, the company had a solid track record. It was big enough for them to buy huge blocks of stock without causing chaos. And its proven ability to keep innovating, that was the final irresistible draw. And this brings us to the absolute core of it all. The arrival of these institutions didn't just add more buyers to the mix, it fundamentally changed how the entire market valued the company. This is the rocket booster that really ignited the stock price. Okay, to understand this, we need to talk about the price-to-earnings ratio, or PE. Just think of it like a popularity score for a stock. It's a simple number that tells you how many dollars investors are willing to pay for every $1 of a company's earnings. A higher PE basically means more confidence, more hype, and a willingness to pay a premium for that future growth. So when Pioneer first went public, the market was willing to pay $18 for every $1 of its annual earnings. A solid, totally respectable valuation for a promising company. But then, the institutions arrived, and their massive, concentrated buying sent a huge signal to the rest of the market. Suddenly, everybody wanted a piece of Pioneer. And this wave of new demand and this newfound sense of legitimacy, it literally doubled the PE ratio. The market was now willing to pay $36 for that exact same $1 of earnings. And here's where the magic math happens. Our investors' amazing return came from two different forces working together. First, you had the 300% growth in the company's actual profits. And second, you had the doubling of the PE ratio, which acted like a powerful multiplier. So the earnings tripled, and the market's valuation of those earnings doubled. You put those two together, and bingo, a 6-fold or 600% total return. So, this brings us all the way back to our original puzzle. If this path to a 600% return is so clear and powerful, why didn't everyone just get in way earlier and shoot for that 12,000% gain? Why would anyone ever settle for less? It's the dream of every investor, right? To find that tiny, unknown company before it becomes the next big thing. But this whole line of thinking misses a critical and often invisible factor when we only look back at the winners. The truth is, in those early, pre-public days, Pioneer Metals was incredibly fragile. The source material says it was touch and go. The founder could have gotten sick. A competitor could have leapfrogged their technology. A crucial bank loan could have been denied. Any one of these things wouldn't have just caused a dip in the stock. It would have completely wiped the company and the entire investment off the map. Gone. And here is the single most important takeaway when it comes to risk. The public investor's 600% gain came after the company had already survived its toughest trials, which made it a much lower risk bet on a proven winner. The early backer's 12,000% gain wasn't just a savvy investment. It was a high-stakes gamble that just happened to pay off. A lot more like winning the lottery than you might think.
Now, I know what you might be thinking. This whole Pioneer Metals example, it sounds a bit too perfect, maybe a little exaggerated to make a point. But as our source material makes crystal clear, the reality is often far, far more spectacular.
Let's just take a look at the real-world Hall of Fame here. Hewlett-Packard, started by two guys in a tiny shop, created over $150 million in value. Texas Instruments turned 4 of its key executives into multi-millionaires, with combined holdings around $225 million. These fortunes absolutely dwarf our fictional example.
And this quote from the source really drives the point home. The author is basically saying, listen, these stories of incredible wealth creation, they aren't just historical flukes. This process is a continuous, ongoing feature of our economy. This happens over and over and over again.
So the key takeaway from this whole explainer is this idea of the two-stage rocket for massive stock gains. Stage 1 is you need a great company with real fundamental growth. But stage 2 is the afterburner, the arrival of institutional buyers, which acts as a massive price multiplier and launches that stock into a whole new orbit.
And that leaves us with a final question for you to really think about. There's no single right answer here, of course, but just understanding this trade-off, this tension between astronomical potential and probable success is absolutely fundamental to understanding how wealth is truly built and risked in the market. Hello and welcome. Today, we're going to talk about one of the most powerful, but honestly most overlooked forces in all of investing. We're going to break down how those massive, eye-popping gains in stock values really happen, and it's probably not what you think. So let's get into it. So let me just ask you, when you see a stock that's gone up, say 4,000%, what's the first thing that comes to mind? For most people, it's got to be that the company's earnings just went to the moon, right? And look, that's definitely part of the story, but it's not the whole story, not even close. In fact, that answer misses the single biggest multiplier of them all. You see, there is another reward that truly outstanding companies give to their stockholders. It's something that, for whatever reason, most investors just seem totally unaware of, even though it has a massive impact on their returns. This overlooked reward is what can take a good investment and make it truly legendary. Okay, so on the one hand, you have what everybody, and I mean everybody, focuses on: earnings growth. The company is just plain making more money. Super important. You can't succeed without it. But on the other hand, you have the secret sauce, PE ratio expansion. Now, this is all about perception. It's when other investors decide they're willing to pay a higher price for every single dollar that company earns. This, right here, is where the real magic happens. So what exactly is this PE ratio? Well, put simply, it's the price the market is willing to pay for a company's earnings. Just think of it like a multiplier. Let's say a company earns $1 per share, and it has a PE ratio of 10. That means its stock price is $10. But if the market gets really excited about that company's future and pushes the PE up to 20, well, the stock price just doubled to $20. And that's even if the company's earnings haven't changed one bit. It's like the market is shining a brighter and brighter spotlight on the company's potential. To really see how this works in the real world, let's follow the journey of a hypothetical company. We'll just call it Pioneer. This little case study does a fantastic job of showing how a company's relationship with the market and that all-important PE ratio changes over time. Okay, so in its early stage, Pioneer is a total unknown. The risk is just tremendous. I mean, it could go to zero. But for the few who take that risk, if it works out, the potential reward is that insane 4,000% gain. Now, let's fast forward 10 years. Pioneer is in its growth stage. It's proven itself. The PE ratio is a nice, healthy 18. The risk is now low, but the potential gain is still a fantastic 600%. You see what's happening? As the company gets safer, its valuation, that PE multiple, climbs. Okay, another 10 years go by. Now Pioneer is in its mature stage. It's a blue chip stock, everybody owns it. The PE is high, up at 36, because everyone knows it's a quality company. The risk is basically gone. But it's hit what you might call the institutional ceiling. Its valuation probably isn't going to expand much more from here. And what's so interesting when you see it laid out like this is the trade-off. In those early days, sure, you've got this astronomical potential gain, but it comes with just extreme risk. Then in the mature stage, it's super safe, but that explosive growth potential, it's pretty much gone. The source material actually points out that for a lot of people, a potential 600% gain with pretty low risk might be a way more attractive investment than chasing that 4,000% gain through a minefield of danger.
So all of this brings us to the core formula, the thing that unlocks the absolute greatest investment success. It's this powerful 1-2 punch that an amazing management team can deliver, and it combines both of the rewards we've been talking about.
It's really a two-step process. First, the company's got to do its job. It has to consistently grow its earnings year after year, decade after decade. That's the foundation. But then comes step 2. This is where the magic is unlocked. As that company keeps proving itself, the rest of the financial community, well, they start to notice. The perception of risk plummets, and the expectation for future growth soars. So the market rewards the company with a higher and higher PE ratio.
And this is it. This is the whole formula right here. And notice it's not addition, it's multiplication. You take the growth in the actual business and you multiply it by the growth in the market's perception of that business. The combination of these two forces is what creates those truly life-changing returns.
But, and this is a huge but, there's a critical warning here. This does not mean you should just run out and buy stocks with low PE ratios. As the source material puts it, a low PE is often just a sign of a mediocre company that the market correctly sees as having a pretty bleak future. It's a trap. The real key is finding a company with a management team that is capable of earning that higher ratio over time.
Okay, so understanding all these principles is one thing, but how do you actually apply them? What do you do with this knowledge? Well, the right strategy really depends on your own personal financial situation and your goals. So let's look at how this might play out for different kinds of investors.
The source suggests two pretty different paths. If you have a smaller amount to invest, you kind of have to make a choice. Is this money your nest egg, something you can't afford to lose? Well, if so, you should probably stick to the safest, mature stage companies. But if it's surplus money that you can afford to risk, you might want to aim for those incredible gains in the early stage companies. Now, for a larger investor, the strategy is different. You build a core portfolio with a solid mix of growth and mature stocks, and then, if you want, you can allocate a small piece to those high-risk, high-reward early stage ventures.
So the bottom line is, this is not a one-size-fits-all deal. There is no single best stage to invest in. By understanding the risk and the reward at each phase of a company's life, you can make way smarter decisions that are perfectly tailored to your needs, your timeline, and your personal tolerance for risk.
We've talked about earnings. We've talked about PE ratios. But what's the deep down force that's driving both of those things? What is the one thing you have to get right for any of this to work? Well, that brings us to the single most important ingredient of them all. The real secret, the rarest and most powerful edge an investor could ever have, is identifying a truly outstanding management team just as they are starting to show what they can do. But, and this is the key part, before the rest of the financial world has caught on and bid up the price. That's the moment when the PE ratio is still low, and you get the chance to ride that incredible wave of both growing earnings and PE expansion. This idea is just captured perfectly in this quote from a major Boston trust company back in the day. Now just think about that breakdown for a second. It's not about complicated economic charts or trying to time the market. It is overwhelmingly about the quality of the people who are running the company. And this chart just drives that point home. 90% of your evaluation, 90, should be focused on the management team, 9% on the industry they're in, and just 1% for everything else combined. Now, while that's not some precise mathematical formula, it gives you the key to understanding where real lasting value actually comes from.
It all comes down to leadership. So, where does all this leave us? We've got the formula, right? Find a company that can grow both its earnings and its market valuation. And we know the key ingredient: outstanding management. So, the ultimate question, the real challenge for every single investor is this: how do you get good at spotting that incredible leadership before it becomes common knowledge, before it's already reflected in a high stock price for the whole world to see? That is the greatest challenge and also the greatest opportunity.
Hey everyone, and welcome. Today, we're going to talk about how picking stocks went from basically just glancing at a report to becoming a full-on forensic investigation. We're going to dig into how some really big mistakes forced investors to get a whole lot smarter, and what all of that means for us trying to find the real winners in the market today.
So here's our roadmap. First up, we'll look at how investors used to basically operate with blinders on and why that was so dangerous. Then, we'll talk about the first big breakthrough, a crazy idea of just, talking to people. From there, we'll get into something called the Scuttlebutt method, which is a brilliant way to get the real story. We'll also see why that amazing method has a tough time keeping up today, which leads us to the future, team-based investing. And then, most importantly, we're going to tie it all together and figure out what it means for you.
All right, let's dive right in. To really appreciate how we do things now, we first have to turn back the clock and see how dangerously simple and, frankly, how disastrous things used to be.
I love this quote because it just nails the old way of thinking. Seriously, imagine trying to choose who you're going to marry based on a couple of posed photos. It sounds completely insane, right? But that is almost exactly how investors used to operate. They would look at a company's published financial statements, and that's it. It's the perfect posed photograph. It shows you the nice smile, but it hides absolutely everything else that's actually going on.
And relying on just that photograph? Well, it wasn't just a bad strategy. It was a total recipe for disaster. The Great Crash of 1929 was the brutal, painful lesson. The losses were so staggering that it forced the entire financial world to face a really hard truth. If they wanted to survive, they had to start digging a whole lot deeper.
So, out of all that devastation came this idea that was actually incredibly simple, but totally revolutionary at the time. The thinking went something like this: if the official documents aren't telling us the whole story, why don't we just go to the source? Why don't we just ask?
And that simple question led to a huge leap forward. All of a sudden, in the 1930s, you start seeing these security analyst societies pop up. And for the very first time, it becomes normal for them to actually call up a company's CEO or CFO. After the war, that went even further, and visiting the company's factories became a standard part of the job. They were finally moving beyond the photographs and actually starting a conversation.
Now, this was a massive improvement, no doubt, but it had a fundamental flaw. When you only talk to the people running the company, you're only ever going to get the official story, the version they want you to hear. I mean, think about it. What CEO is going to willingly tell you about their company's biggest problems? It became pretty clear that another layer of investigation was desperately needed.
And this brings us to a technique that is truly groundbreaking. This is the point where investment analysis stops looking like accounting and starts looking a lot more like real detective work.
It's called the Scuttlebutt method. Yeah, the name sounds a little old-fashioned, but trust me, the idea is pure genius. It's the art of building a complete 3D picture of a company by talking to everyone around it, their customers, their suppliers, their biggest competitors, even people who used to work there. Each one of those people holds a unique little piece of the puzzle.
The process itself is what makes it so incredibly powerful. See, you start by talking to all those outside sources first. Then, once you're armed with all that on-the-ground intelligence, you come up with some very specific, very targeted questions. And only then do you go talk to management. You see the difference? You're no longer asking them to tell you their story, you're asking them to confirm or deny what you've already found out. It just completely changes the entire dynamic of the conversation.
And here is a perfect real-world example of why this is so effective. An analyst using this method discovered a company was just burning a fortune on R&D. But why? Well, it turned out the head of research and the head of sales just flat out hated each other. And because they couldn't get along, the company was developing these brilliant products for markets that were way too small. Now, that is the kind of critical, company-killing weakness that you will never, ever find in an annual report.
Okay, so the Scuttlebutt method is obviously an incredibly powerful tool for getting to the truth. It sounds like the perfect solution, right? The ultimate answer. But in our hyperfast, modern world, it has one major, almost fatal flaw. So what's the catch? It's actually really simple. Time.
In today's market, things happen in a flash. The world just isn't going to wait around for one person to conduct a leisurely, months-long investigation. It all just moves way too fast. I mean, just think about the challenges for a single investigator. It's just too slow. Finding the right people to talk to, who might be scattered all over the globe, is a huge hurdle. That makes cross-checking what you're here incredibly difficult. And honestly, here's the most frustrating part. While you're doing all this amazing, essential work, the market often figures it out first, and the stock price takes off without you.
So, this massive problem of speed and complexity, well, it leads us to the next big evolution in how we analyze investments. And funny enough, the inspiration for this next big leap doesn't come from the world of finance, but from industrial R&D.
Just look at the contrast between these two models. On one side, you have the lone expert. They're probably based in one city, they're constantly on a plane, and they're trying to cover everything themselves. It's slow, and it's totally subject to that one person's biases. But on the other side, you've got the team model. Here, you have experts based in key regions all around the world. Information flows instantly, it's cross-checked by multiple people with different points of view, and the analysis is fast and coordinated. It's a quantum leap from a solo craft to a high-performance system. Think about it like this. Compare an old propeller cargo plane to a modern jet. The jet is way more expensive to operate per hour, right? But because it's so much faster and can carry so much more cargo, the actual cost to ship a single package is dramatically lower. The exact same logic applies here. A research team has higher overhead, sure, but its ability to produce more insights, better insights, and faster insights makes it just vastly more powerful and efficient in the end.
So, we've traced this entire path, from simple photographs all the way to these high-tech research teams. Okay, great. But what does any of this mean for you, the individual investor? How can you actually apply these lessons?
Let's be realistic. You're probably not going to go out and build a global team of analysts tomorrow. The key here isn't to perfectly replicate the method, it's to adopt the mindset. It's about understanding what truly creates value. When you're looking at an investment, or even when you're just looking for advice.
You know, people can get really hung up on job titles. Is my advisor an investment counsel or a stockbroker? In theory, one acts solely for you, while the other might be focused on commissions. But in the real world, the title on the business card matters a whole lot less than the actual method being used. If an advisor is spending all their time just managing clients instead of doing deep research, their title is completely irrelevant. The real question you should be asking is, are they doing the hard, scuttlebutt-style work that's needed to generate real insight?
3,000%. Why is this number so important? Well, because it hammers home a really profound point. Way more money has been lost by investors selling a great stock too early for a tiny profit than from almost any other mistake you can make. But to have the courage to hold on for a 3,000% gain, that requires a deep, unwavering conviction, the kind you can only get from truly knowing the full story behind what you own.
So ultimately, it all boils down to these key principles. You have to think like a detective, not just someone who reads reports. You've got to actively hunt for the full story, not just the pretty official one. You need to understand a company's entire world, its customers, its rivals, its suppliers. And most important of all, you have to know the why behind your investment so clearly that you have the guts to hold on with conviction through all the inevitable ups and downs. And that leaves us with one last, crucial question for you to think about. When you look at your own investments, are you making your decisions based on that simple posed photograph? Or are you committed to doing the hard work it takes to learn the full, three-dimensional story? The answer to that question could make all the difference. You know, picking someone to help guide your investments is one of the biggest, highest-stakes decisions you're probably ever going to make. The right choice? It can literally secure your future. But the wrong one? Well, that can be devastating. So, in a world that's just jam-packed with impressive titles and super confident pitches, how in the world do you find someone you can actually trust? Let's break it down. Okay, so you've seen them all, right? Broker, counselor, banker. They all sound so official, so important. But what do those titles really mean when it comes to your money? Well, here's the first and most important thing you absolutely need to get. The real answer has nothing to do with what's printed on their business card. And yeah, here's the frustrating truth of it all. Those titles, they mean zip, zero, nothing when it comes to the quality of the advice you're getting. So if we can't trust the fancy titles, what can we trust? We have to stop focusing on what doesn't work and start building a real framework for what actually does. So, here's the game plan. We're going to tackle the investor's core dilemma. Then I'll give you a 5-step litmus test you can use on any advisor. We'll look at how to judge their organization, touch on the rise of investment trusts, and finally, we'll talk about why doing all this is the most important investment you'll ever make. All right, first up, the investor's dilemma. Because look, to find the right answer, we first have to really understand why so many people get this so wrong.
And now for the main event, a 5-step litmus test. Think of this as your practical, step-by-step framework to find an advisor who's not just competent, but is genuinely trustworthy too.
Here are the 5 steps we're going to walk through. We're going to uncover their real motive, define their philosophy, scrutinize their data, test for honesty, and check their record. Let's dive right into the first one, because honestly, it's the big one.
Step 1 is absolutely critical. If you only remember one thing, make it this. You have to uncover their true motive. Are they really in it for your long-term benefit, or are they just focused on the immediate commission they're going to make off you? The fastest way to find out? Don't just listen to their sales pitch. Go talk to their other long-term clients. If their number one goal isn't your success, you cross them off the list. Period. End of story.
Okay, step 2. What is their investment philosophy? You've got to know what they're trying to do and exactly how they plan to do it. And listen, the key here isn't whether their philosophy is right or wrong in some abstract sense. The only thing that matters is whether it lines up perfectly with your goals and what you're comfortable with.
Step 3 is all about digging into their data, and this introduces a fantastic concept, Scuttlebutt. This isn't just about reading financial statements. No, this is the real detective work. It's the art of finding out what's really going on inside a company, from its customers, its competitors, even former employees, long before that stuff becomes public knowledge. This is the difference between just scratching the surface and doing truly deep research.
And this is why that scuttlebutt thing is so important. See, an advisor who just parrots back what a company's management is telling them is only giving you one side of the story. It's totally unbalanced. And as this quote says, that can be incredibly dangerous. You need someone who digs for the whole truth, not just the company's latest press release.
This leads me to a perfect cautionary tale. So, a broker from a huge firm was bragging about the sheer volume of research reports his company pumped out. But when the author actually read one on a company he knew inside and out, he saw it was just shallow, surface-level work. And get this, the punchline? That same broker later came back, admitted the firm's research was awful, and asked for help finding a new job. It's such a powerful reminder, the quality of the research will always trump the quantity. All right, step 4. This one's a really simple but powerful honesty check. Nobody, and I mean nobody, can be an expert on everything. A truly trustworthy advisor will be the first one to tell you what they don't know. As this quote warns us, the person who pretends to have all the answers, that's the most dangerous person in the room. Real expertise includes knowing your limits.
And finally, step 5. Check the record. But, and this is a big but, you have to do it intelligently. You want to see a history of at least 3 years, and you need to dig into the details. For instance, a poor record might not even be the advisor's fault if the client kept ignoring their advice. And always ask, is this track record I'm seeing from this specific person, or is it just the firm's general performance? Big difference.
So now we have a test for the individual advisor. But let's zoom out a bit, because you're not just hiring a person, right? You're hiring the entire organization that's standing behind them. So our next section is all about judging the firm itself. So does the size of the firm even matter? Honestly, not as much as you might think. Sure, the big firms have more resources, but a really well-managed small firm can often run circles around them. At the end of the day, skill and efficiency are way more important than sheer size, so don't get automatically swayed by a big, famous name.
But here it is, the single biggest red flag for any firm. I don't care if they're big or small. It's the one where everyone is too busy for proper, diligent investigation. If an advisor ever tells you they don't have time for more than a quick phone call to a company officer, that's your signal to run. It's a sign of a dangerous, corner-cutting culture.
Next up, let's pivot a little and talk about the rise of investment trusts, what we'd all call mutual funds today. It's a fascinating question. Why did this simple promise of just being average suddenly become so incredibly appealing to millions of investors?
You know, you might think the growth of these funds was all about brilliant marketing or the appeal of diversification, and yeah, that was part of it. But the single biggest driver, a whopping 40%, was just plain old frustration. So many investors turned to funds for one simple reason. They couldn't find trustworthy, high-quality advice anywhere else.
The industry's own failure created its biggest competitor. And that brings us to our final and maybe most important section. This is where we address that number one excuse for not doing all this homework. You know the one, I'm just too busy. Well, as we're about to see, that is an excuse you simply cannot afford to make.
This quote just hits the nail right on the head, doesn't it? It's never really about having time. It's always about making time for what we decide is important. And just to show you how massively important this is, let's do a little thought experiment.
Let's play a little game. We'll call it the pin the tail on the donkey test. Imagine you take the stock listings, close your eyes, put your finger down on 20 random stocks. Now, if you held those for 5 years, what do you think would happen? The results are, well, they're pretty shocking.
What you'd find is a truly staggering range of outcomes. I mean, some of those stocks would be down 50%. A lot of them would be kind of flat, maybe up or down a little, but a few would have doubled or even quadrupled in value. And one or two, they might be up 1,000% or even more. The gap between the best and the worst isn't just big, it is absolutely life-changing.
And that right there leads us to the key takeaway of this whole thing. Given that enormous difference between incredible success and failure, the time you spend investigating, vetting, and selecting the right person to guide you isn't a chore. It is, without a doubt, the single most valuable and highest returning investment you will ever make.
So I'll just leave you with this one final thought. We all know finding the right advisor takes time and it takes effort. But given the enormous stakes we just talked about, the real question you have to ask yourself is this: what is the cost of failing to do so?
All right, let's talk about one of the biggest, most high-drama events in the business world: corporate mergers. You see that headline, right? Two giants are joining forces. And as an investor, your first thought is probably, is this going to make me rich? Or is this a total train wreck waiting to happen? Well, that's exactly what we're going to figure out today. How do you tell the difference between a brilliant move and a complete disaster? Let's dive in. Okay, here's how we're going to break it all down. First, we'll look at why everyone gets so hyped about mergers in the first place. Then, the potential payoffs. After that, we'll get into the really juicy stuff, the hidden dangers and all the things that can go wrong. Then I'll give you an investor's playbook to spot the good from the bad. We'll even touch on a smarter alternative you might not have thought of. And finally, we'll wrap it all up with the final word on growth.
So let's start at the beginning. The allure of mergers. You know, why do companies and investors just love the idea of joining forces? It's because, let's be honest, it feels like the ultimate power move in the corporate world.
And to really get why it's so tempting, let me ask you this. Just put yourself in the CEO's shoes for a second. What is the absolute fastest way for your company to grow? I mean spectacularly, overnight growth.
Yep, you just buy another company. It's the ultimate shortcut, isn't it? Forget spending years, maybe decades, building from scratch. Poof, you instantly get all their sales, all their customers, their entire market share. I mean, on paper, it looks like a slam dunk for explosive growth.
Okay, so let's look at what that slam dunk actually looks like. We're talking about the potential payoffs. Because, look, when these deals work, and that's a big when, the benefits can be just massive. This is the dream scenario that makes these deals so tempting.
So here's how a merger should work in a perfect world. First, you get huge operational savings. You merge the sales teams, the HR departments, production lines, and boom, your costs go way down. Then you might get a serious management upgrade. Imagine a super efficient team taking over a company that was, let's just say, not so well run. Plus, think about product innovation. The acquiring company's top-notch R&D could totally transform the products of the company they just bought. And of course, there are the financial gains. A bigger, stronger company can often refinance the old debt at a way better interest rate. It all sounds pretty great, right?
But you knew there was a but coming, didn't you? It's not all sunshine and synergies. And that brings us to the really important part, the hidden dangers and pitfalls. This is where that beautiful dream on paper slams headfirst into a much messier reality.
Because here's the thing, and it's a big one. There's a catch. Think of it like this. It's like a long forward passing football, a real Hail Mary. If it connects, oh man, it's spectacular. You gain a ton of yardage, everyone's cheering. But what's the risk? An interception, a total disaster that can lose you the game. A corporate merger is exactly that. It's a high-risk, high-reward gamble, when maybe just running the ball for a few safe yards would have been the smarter play. So where does all this risk come from? Well, a huge part of it is that the seller almost always knows more than the buyer. I mean, think about it. The seller has lived and breathed that business for years. They know where all the bodies are buried, all the weak spots, all the problems hiding under the surface. The buyer, they're just peeking under the hood for a few months. It's a massive information disadvantage right from the start. There's this fantastic, if a bit old-fashioned quote that just nails this idea. A very smart CEO once said, "It's only after you have married the girl that you find out about the false teeth and the wooden leg." And for him, this was real. The false teeth turned out to be factories that were in way worse condition than they looked. And the wooden leg? A huge morale problem with the executive team he just inherited. These are the nasty surprises you only discover after the deal is done and it's too late. And usually these nasty surprises fall into 3 buckets. First, there's the internal friction. Suddenly you've got 2 marketing VPs, 2 finance chiefs, and they're all fighting for the same job. Teamwork? Gone. It's every person for themselves. Second, you get management overload. The leaders who were geniuses at running their old company are now drowning in problems they've never seen before. Their efficiency just tanks. And finally, number 3, those hidden flaws we just talked about. The buyer discovers problems that are way, way worse than they ever could have imagined. Here's another great way to think about it. A merger is like major surgery. Now, what's the hope with surgery? That long-term, the patient is going to be much better off. But what's the short-term reality? The patient is always, always weaker right after the operation. They're vulnerable. And things can go very, very wrong on the operating table. A merger is just like that. Even if it's successful, the company will be weaker for a while. And if it's not, well, it can be left permanently damaged. All right, enough with the doom and gloom. We get it. Mergers are risky. So now for the really useful part. As an investor, what do you look for? How can you tell a smart merger from a disaster waiting to happen? Well, that brings us to our Investor's Guidebook, a set of rules to help you figure out a merger's real chances of success. Let's kick things off with the safest types of mergers. First up is something called backward integration. Sounds fancy, but it just means buying one of your suppliers. The risk here is super low because you already know their business inside and out. The second safe bet, tiny acquisitions. Think about it. If a giant company buys a tiny startup and it fails, who cares? It's a rounding error. But if it succeeds, wow, they might have just bought the next big thing in tech for pennies on the dollar. Okay, next rule. What's the right fit? This is a big one. Your chances of success shoot way up when a company merges with another one in a field they already understand. You know, a car company buying another car company. They get it. The disasters, those almost always happen when a company tries to merge with something completely different, a business they know absolutely nothing about. That's just asking for trouble. You also have to look at the personality of the company making the deal. Is it an occasional acquirer? That's usually a great sign. It means they only pull the trigger when a deal is just too good to pass up. The one you have to be really careful of is the serial acquirer, the company that's always on the hunt, constantly making deals. They're often just trying to look busy and grow at all costs, and that desperation leads them to make really bad, overpriced deals. And keep your eyes peeled for a few more big red flags. First, if a deal looks like a bargain, be suspicious. Buying a broken business for cheap doesn't mean you got a good deal. It means you bought a ton of problems. Also, watch out for what the legendary investor Peter Lynch called diversification. That's when a really great company starts buying a bunch of so-so businesses, and it just waters down what made them great in the first place. It all comes back to this. The more scattered a company gets, the more its management gets stretched thin. So we've talked a lot about the dangers of buying another company outright. But is there a smarter way to grow? Yes, there is. And it brings us to a really interesting alternative: the world of jointly controlled companies. So what on earth is that? You probably know it as a joint venture, and it's totally different from a merger. It's not about one company buying another. Instead, it's when 2 or more companies team up to create a brand new company together. Each parent company brings something special to the table. One might have the amazing tech, the other might have the incredible sales force, and they built something new that neither of them could have done on their own. And you know what's crazy? The success rate for these things is surprisingly high. And it makes sense when you think about it. You're combining the best of both worlds, say a great technology with great marketing. You get to cherry pick experienced managers from both parent companies to run the new thing. And this is key, you completely avoid all that nasty infighting you get in a merger because everyone is starting fresh on a new team. Plus, you can pool your money to do really big, ambitious things.
But here's a weird little quirk that, as an investor, you should know about. For some reason, the stock market often doesn't give these joint ventures the credit they deserve. So look at this. When the parent company keeps its profits, Wall Street loves it, and the stock is valued highly. But when the successful joint venture keeps its profits to grow, Wall Street kind of shrugs. They value it less. It's almost like a psychological thing. Because those assets are one step removed from the main company, investors just don't value them as much.
All right, it's time to bring it all home. Let's get to the final word on growth. We've seen the exciting promises of mergers, and we've definitely seen the huge dangers. So what does this all mean for you, the smart investor?
So here's my challenge to you. The very next time you see that big, flashy headline about a corporate merger, what are you going to see? Are you going to see the guaranteed power move, the shortcut to riches? Or are you going to see the dangerous gamble, that long, risky pass down the field? Because knowing how to answer that question, well, that could make all the difference in the world to your investments.
When you buy a share of stock, what are you really buying? You're told you're buying a voice, a vote. It's supposed to be the absolute core of corporate democracy, right? The fundamental power that you, as an owner, hold. But what if that power isn't really what it seems? What if it's more of an illusion?
And that's the big question we're diving into today. Is that proxy ballot you get in the mail a genuine tool for change? Or is it just a bit of corporate theater? We're about to unpack a really powerful and honestly kind of controversial argument that suggests the answer is not at all what you'd expect.
So, here's how we're going to break it all down. First, we'll look at the conventional wisdom, what everyone thinks about shareholder rights. Then, we'll blow up a flawed analogy that causes a ton of confusion, before getting to the investor's ultimate choice. After that, we'll see why most of these fights are just futile. And finally, discover where your true power actually lies.
Okay, first up, this whole idea of corporate democracy. You know, the story we're all told is that the shareholder vote is the very bedrock of how companies are supposed to be governed. It's sacred.
And look, on the surface, it seems incredibly important. Your vote elects the board, and the board then picks the CEO and all the other top execs. They set the big picture corporate policy. Regulators treat this right as so vital that if a company tries to mess with the one share, one vote standard, they have to explain it in excruciating detail. Plus, we've all read the articles and books about crusading shareholders fighting for their rights. It all feels so powerful.
But then our source material just drops this bombshell. The idea that for a serious, sound investor, voting is, get this, unimportant. How can that possibly be true? Well, let's find out.
Well, a huge part of the confusion comes from a flawed comparison that we all kind of make instinctively. We tend to think about our role as a shareholder the same way we think about being a citizen in a democracy. But it turns out they are fundamentally completely different.
And this slide just lays it out perfectly. As a citizen, right, you have deep ties to your country. Leaving is a massive, life-changing decision. If you're indifferent about politics, the consequences can be dire because, well, you're stuck there. But as a shareholder, your ties are totally fluid. Selling your shares is a simple transaction that takes seconds. If you don't like the government, that is the management, you can just switch to a company with a better one. That incredible ease of exit, it changes the entire game.
So this freedom, this mobility, it leads to a really clear and surprisingly simple philosophy for any investor. It basically boils down to a binary choice. There's no in between.
And this is the crucial point. You either trust the management team and you back them completely, or you don't. And if you don't, you should sell your stock. That's it. There is no murky middle ground of half-hearted opposition or fighting from the inside. This is the central rule.
So let's put this into practice. Let's say you really trust a management team, but they do some small thing you don't like. Before you jump into action, you got to ask yourself a few things. First, just acknowledge they probably know more about the situation than you do. Second, seriously question if your own view is the right one. A truly great team has earned some freedom to operate. Fighting them on every little thing just creates resentment and strain, and that can be way more costly than whatever minor issue you were upset about.
Okay, but what about the big stuff, the extreme case? What if a proposal is so bad, so fundamentally wrong in your eyes, that it threatens the whole reason you invested? It's a deal breaker. Now you have to fight them, right? Surely now is the time to act.
Not so fast. Before you launch that crusade, you have to ask yourself two really tough questions. First, is there any realistic chance you can actually win this fight? And second, think about this. If a management team you once trusted is now pushing a plan you think is this bad, haven't they already shown you that their judgment has failed beyond repair?
And when you're honest with yourself, the answers to those questions almost always point to the exact same conclusion. Your chances of winning are probably tiny, and the bad proposal, it isn't the real problem. It's just a symptom of a much deeper rot in management's judgment. So fighting is a distraction. The most logical, self-interested, and effective move is to sell your shares and go find a better-run company.
And that brings us to the fight itself. You know, we all hear these heroic stories about shareholder activism. But the hard reality is that for most regular investors, a proxy fight, which is just trying to convince other shareholders to vote against management, is almost always a losing game. Just think about it for a second.
By the time a company is in such bad shape that a proxy fight actually breaks out, the best and brightest young talent has probably already bailed for better opportunities. And even if the rebels win, it can take years to turn the ship around and see real results. And who are these insurgents anyway? Sometimes they're visionaries, sure, but often they can just be unproven, glib opportunists who are good at talking a big game. The data shows that in the years after a proxy fight, the stock rarely performs any better than the market average. And here's the kicker. This is why winning is so hard, and it's where that citizen shareholder analogy just completely falls apart. A really powerful political machine might control, say, 20% of the vote. That's tough to beat, but it's not impossible. But in the corporate world, an entrenched management can often lock down over 50% of the vote through friendly institutions and proxy machinery. The fight is literally over before it even begins.
So this all leads to a pretty cynical, but I think really practical conclusion from our source. The whole spectacle of shareholder voting and proxy fights is often more about ego, about people who like to pop off or flex their legal muscles, than it is about the one thing most of us actually care about, making money.
So, if the vote is basically worthless, where is your power? I mean, do you even have any? And the answer is yes, you absolutely do. And it is far more potent than any paper ballot. Your real power is found in the market itself. Our source has a great name for it, the bloodless verdict of the marketplace. This is the real force for change. It's the powerful, collective pressure that shareholders create not by casting a meaningless vote against management, but by simply selling their shares. It's voting with your feet, and it sends a signal that no board or CEO can afford to ignore.
Here's exactly how it works. When enough unhappy investors start selling, it sends a crystal clear signal of disapproval. That constant selling pressure pushes the stock price down, especially relative to its competitors. Now this hits management where it really hurts, in their own stock options, their own personal net worth. On top of that, it makes it more expensive and difficult for the company to raise money in the future. See, a few angry votes at the annual meeting can be ignored. A relentlessly falling stock price cannot.
And if you need one final, undeniable piece of proof of how the market itself values the vote, look no further. This number, 0. That's the typical price difference between a voting share and a non-voting share of the very same company. The market, the ultimate judge, is screaming at you that the right to vote is, in monetary terms, completely worthless. So what's the big takeaway from all this? It really boils down to a whole new philosophy, a kind of creed for the successful investor when you think about your role as an owner of a business. Here it is, your new creed. Number 1. Just ignore all the noise about voting rights. It's mostly a distraction. 2. Concentrate all your energy on finding companies with truly outstanding management. That's where the real work is. 3. When you find them, support them. Back them consistently. And 4. Never, ever forget that your most powerful tool, your true vote, is your sell button. So the next time you get a proxy ballot in the mail, or you find yourself getting frustrated with a company's direction, just ask yourself this one simple question. Is my sell button more powerful than my ballot? Because according to this entire line of thinking, the real power isn't in checking a box. It's in the beautiful freedom to take your capital and put it somewhere better.
So here's the big question, right? Should the prospect of a Democratic or a Republican win actually make you buy or sell stocks? It's a huge deal that mixes our deepest political feelings with our financial future. But we're about to break down a pretty fascinating argument for why you might be thinking about all of this completely wrong. So let's just dive right in. The author kicks things off with this brilliant analogy. Just think about the last time you were at a college football game, right? You might not know a single player on that field, but the second the band strikes up that song and you see those school colors, you are all in. It becomes our team. And the argument here is that our political loyalties work kind of the same way. It's less about pure logic and more about this deep, emotional, and sometimes, let's be honest, irrational partisanship. Okay, so here's our game plan. First, we're going to talk about politics in your portfolio and the two big competing beliefs that most investors have. Then we'll get into the counterargument, this idea of a great political center. We'll look at a wild case study that goes way beyond party labels. And then finally, we'll lock in a solid rule for long-term investors before, and this is the fun part, we'll finish with a really surprising tactic for short-term timing. And that brings us right into our first section, politics and your portfolio. The real issue we're tackling here is how that our team feeling, that emotional gut reaction, can start to creep into what should be really clear-headed financial decisions. What's really wild is that social scientists have shown that our political views are often shaped by things we don't even consciously think about. I'm talking about the state you grew up in, your neighborhood, your background, your economic class. All of these things act like these invisible ropes, just kind of pulling us toward one party or the other. And before you know it, we start just accepting our party's talking points, and that starts to color how we see everything, including the stock market. So let's look at what this partisanship really leads to. This takes us to Section 2, two sides of belief. This really covers the common wisdom, or maybe the common conflict, that you hear among investors whenever politics comes up. Okay, so on one side of the ring, you've got this belief that the Republican Party is the businessman's party. The logic is simple. They get business, so when they're in charge, stocks are going to do well. But then, on the other side, you have the idea that Democrats are the party of good times. People who believe this will point to the Great Depression under a Republican president as proof that, no, actually, Democrats are the ones who keep the economy stable. And these are two really powerful, totally opposing stories that drive a ton of investment chatter. But what if both of these views are missing a much deeper truth about American politics? Let's get into Section 3, the Great Political Center. This is really the author's core argument against all of this politically driven investing. So here it is. The whole idea hinges on this. The author argues that the vast, huge majority of American voters are at their core moderates. They don't like extremes on the right, and they don't like extremes on the left. And this one single fact has massive consequences for how politicians actually govern, no matter what their party is. And this just shows you exactly what happens next. Once they get elected, politicians from both parties start to drift toward this powerful, moderate center. Because, well, that's how you get reelected. A Republican president might start chasing antitrust cases you'd expect from a Democrat. A Democratic president, for all their tough talk, might end up having tax views that are surprisingly moderate and do very little that's actually harmful to business. See, it's not about their personal beliefs. It's about what they have to do to win over that massive group of voters in the middle. But to really prove this point, we've got to go beyond just theory. So let's jump into Section 4, Beyond Party Labels. This case study is the perfect example of just how misleading a party label can be when you're looking at actual policy. So the author brings up this piece of legislation that sounds kind of harmless, right? The excess profits tax. But he argues that this tax, despite its name, was one of the most economically damaging laws of its era. Let's dig into why. This tax was so bad because it went after the most efficient, most innovative companies, the ones literally building new industries and creating jobs. It basically rewarded inefficient companies, it encouraged wasteful spending because, hey, the government was footing a big part of the bill anyway, and it even made labor relations worse. Just a truly terrible piece of legislation from a business point of view. Okay, now here's the twist. You'd think this was a purely Democratic idea, right? And yeah, it did originally get its support from them. But then, in 1952, a Republican administration called for it to be extended. And at the same time, some of the liberal Democrats who had seen firsthand the damage it was doing in their states, they actually started to lose their taste for it. The point is, the party lines got completely scrambled. You couldn't predict who would support it just by looking at their party. All right, so what on earth does this all mean for you and your money? Well, this brings us to the main event. Section 5, the long-term investor's rule. This is really the big takeaway for anyone who's investing for the long haul. The rule is actually really simple, but it's also incredibly powerful. Do not make your long-term investment decisions based on which party wins or loses an election. Now, the author adds a really important fine print here. This rule only holds true as long as that great political center we talked about, that moderate American voter, continues to exist. And to show you the real-world cost of getting this wrong, the author tells this fantastic cautionary tale. Back in the early days of the New Deal, a lot of wealthy Republican investors were so terrified of the new administration that they just pulled their money out of the market or sat on the sidelines. And what happened? They completely missed out on the incredible investment opportunities of that period. They were so blinded by their political fear that it cost them a fortune.
Now, just when you think you've got the answer, okay, ignore politics, got it, the author introduces this absolutely fascinating twist. So let's get to our final section, a short-term timing tactic. This is the surprising exception for anyone who's already thinking about trading around an election.
Which, of course, raises the big question. If we're supposed to ignore politics for long-term investing, is there ever a time when elections actually do matter for timing your trades? And believe it or not, the author's answer is a surprising yes. The key insight here is all about market psychology. For years and years, the stock market has shown this really consistent pattern. It overreacts. It basically prices in the expected election results so aggressively before the vote even happens that when the predictable news finally arrives, the market does the exact opposite of what you'd expect. It is a textbook case of buy the rumor, sell the news.
And this just lays out the pattern perfectly. I mean, look at Franklin Roosevelt's landslide elections. Everyone expected him to win, the market was supposedly terrified of it, and yet, the day after he won, stocks shot up. And on the flip side, in the 1946 midterms, Republicans were expected to sweep Congress, which should have been great news for stocks, but the day after their victory, the market took a sharp dive. The market literally sells the news. So, based on this, the author lays out a very specific timing rule, but only for those who are already planning a transaction. First, check the betting odds to see who the favorite is. If Republicans are favored to win, you do your selling before Election Day to take advantage of that pre-election hype. And then you do your buying after the expected post-election dip. If Democrats are the favorite, you do the exact opposite. You buy into all that pre-election pessimism, and then you sell into the relief rally that often happens afterwards. But what happens when the betting odds are just flat out wrong? Well, during a real upset, the pattern flips. When Truman pulled off that shocking victory in '48, the market hadn't priced it in at all, and it kept on selling. But when Republicans defied all the expectations in the '54 midterms, there were, and I quote, real fireworks on the upside. The surprise just makes the move that much bigger. So the ultimate takeaway here is really a two-part strategy. For the long-term investor, the message is crystal clear. Just tune out all the political noise. Why? Because that great moderate center of the country tends to smooth out any extremes. But for a short-term trader, there's this fascinating psychological pattern you can potentially use, where the market just consistently overreacts to the expected outcome. And all of that leaves us with one final, really crucial question. The author's entire argument, both for the long term and the short term, it all hangs on this one single idea, a moderate American electorate that pulls both parties back to the center. So we have to ask ourselves, in today's political climate, does that assumption still hold up? And if it doesn't, what in the world does that mean for our portfolios? All right, today we're going to do something a little different. We're hopping in a time machine and heading back to the 1960s to dig into a fascinating and honestly pretty counterintuitive investment philosophy. We're diving into a classic text that basically told everyone to forget the get-rich-quick dream and instead embrace a slow but sure path to building wealth. And it's all seen through the lens of the chemical industry. So to really get what's going on here, you first have to understand the popular myth at the time. Back in the 60s, the chemical industry was seen as, well, pure magic. Investors pictured this amazing machine, this magic conveyor belt of innovation, just constantly churning out miracle products, and of course, these effortless, ever-growing profits. It was the absolute glamour stock of its day. But our source material comes along and just throws a huge bucket of cold water on that whole fantasy. The author's main point right out of the gate is that this popular idea couldn't be more wrong. He argues that the chemical industry is not a get-rich-quick scheme. Nope, it's something else entirely. Okay, so here's the game plan for this explainer. First, we're going to tear apart that magic conveyor belt myth.
Then we'll get into the reality of what our author calls slow growth, sure profits. After that, we'll talk about the big problem this creates for investors, lay out 3 very specific times you should think about buying, and then at the end, we'll ask the big question, does any of this 1960s wisdom actually still work today?
First up, let's really dig into this myth. I mean, you can see the appeal, right? The idea that you could invest in a sector that seemed to have a lock on the future, well, that's pretty intoxicating. And this whole perception shaped how a whole generation of investors saw the market, and it often set them up with some seriously unrealistic expectations. And now we get to the heart of the argument. This is where the author just systematically takes that myth apart, piece by piece, and replaces it with something a lot more sober but ultimately way more powerful. The truth, he says, isn't about speed. It's all about strength. This slide just lays it out perfectly. On one side, you've got the get-rich-quick model. Think about the electronics industry back then. You're seeing this explosive, kind of wild growth of 25, even 40% a year. But on the other side, you have the get-rich-sure path of the chemical industry. It's growing at a steady, but much slower, 7.5%. Now, that's still way faster than the overall economy, but it's not explosive. It's consistent. It's predictable. So why was the growth slower? A huge part of the answer is capital. Just think about this for a second. To generate $1 extra in sales, a chemical company had to sink about $1 into building new plants and equipment. That incredible need for cash acts like a natural speed limit on how fast any company can grow. And on top of the money, it's the time. I mean, look at this process. Innovation doesn't just happen overnight. From a simple idea in a lab to actually getting a product into a customer's hands, you're looking at a journey that takes years. You've got pilot plants, then massive construction projects, and even after all that, you still have to convince customers to actually use the thing. It's a total marathon, not a sprint. Okay, so this is the crucial pivot. This is the big aha moment. The author argues that the very things that stop you from getting rich quick, the insane capital costs and the super long development cycles, are the exact same things that let an investor get rich sure. These aren't weaknesses. They're the very foundation of the industry's strength. Think of it like a company building an impenetrable fortress. The huge capital costs, that's a massive wall that keeps startups out. The complex technology, that's a deep, wide moat that outsiders just can't cross. The diverse product lines mean that even if a competitor attacks one part of the castle, the rest of it is totally fine. What you end up with is this incredibly durable competitive advantage for the companies already at the top. And all of this leads us right to the central problem for an investor. I mean, if the best companies are so strong and it's so obvious who they are, how do you actually make a great return? The challenge completely shifts from what to buy to when you buy it. And here is that dilemma in a nutshell. On one hand, picking out the industry leaders, the big names of the era, is actually pretty easy. They're the established giants. The hard part, the real art, is timing your purchase. Why? Because everybody knows these companies are great, so their stocks are almost always expensive, with all that future growth already baked into the price. This leads a lot of people straight into a common mistake the author calls the almost as good trap. An investor sees the super high price on a top-tier company and goes looking for a bargain in a second-tier one. But they often wind up paying nearly the same high price for a company that just doesn't have the same guarantees of growth. It's a really dangerous game.
So, if timing is everything, how in the world do you find the right moment to pounce? Well, the author gives us a practical guide, pointing out 3 very distinct scenarios where value shows up for the investor who's patient enough to wait for it.
The first opportunity is probably the most straightforward, a big recession. You see, investors often believe these giant companies are depression-proof, but they're not. Their sales are cyclical. Their earnings will fall. The key is because their underlying growth is so strong, they bounce back way faster and stronger than almost anyone else. So the strategy is simple. Wait for the market to panic and buy the best of the best when everyone else is feeling down.
The second opportunity is more specific. And wow, this case study of the Beryllium Corporation is just a perfect illustration. In '57, a big contract sends the stock soaring on hype. But then, disaster. Technical problems, huge losses, and the stock just gets crushed as everyone panics. But here's the key. The long-term potential of the company was still totally there. The patient investor, who knew these were just temporary setbacks, could buy into a fantastic story at a massive discount, while everyone else was running for the hills. Now, this third opportunity is the most subtle. This is for the real detectives out there. It involves finding a company that's just okay, good but not great, and then spotting when a new, really sharp management team takes over. For a few years, as the new team cleans house and invests for the future, the numbers might not look great. The market doesn't notice. This lag effect creates a window for you to buy into a company that's about to have a major turnaround before anyone else catches on.
So we've broken down the myth, we understand the reality, we've even identified the opportunities. But the elephant in the room is, does this 60-year-old advice actually apply in our modern, crazy, fast-paced market? I think when you really boil it down to its core ideas, the answer is a huge yes. First, debunk the myth. Today's hot glamour industries might not be the best long-term plays. Look for the slow but sure. Second, remember that barriers to entry, those huge costs and complex tech, are your best friend as a long-term investor. Third, focus on when you buy, not just what you buy. And finally, be a contrarian. The best deals happen when there's fear in the streets, not hype. And this quote just sums up the whole philosophy perfectly. The goal isn't just to find the fastest growing stock. The goal is to find a good, desirable rate of growth that's backed by an unusual degree of certainty. It's a trade-off, really. You give up some of that explosive lottery ticket potential for a much, much higher chance of success over the long run. So that leaves us with one final thought to chew on. This whole framework was built for the chemical industry of the 1960s. But if you look around today at all the industries grabbing the headlines, which ones do you think might be misunderstood? Which of today's get-rich-quick darlings might actually be tomorrow's slow but sure champions just hiding in plain sight?
So today, we're going to do something a little different. We're going to travel back in time, back to the 1960s, to dig into what was then the hottest investment sector around, electronics. We're going to look at a classic guide for navigating this world of high growth and, super high risk. And what's really fascinating is how these old principles might just give us a whole new lens to look at the tech titans of our own time.
And this quote right here, it just perfectly captures the vibe, the absolute allure of the electronics industry back then. This wasn't just about making a decent return. It was about the chance for, as he says, sensational long-range rewards. We're talking life-changing money, the kind of opportunity that could completely rewrite your financial future.
And hey, this wasn't just some pipe dream, it was really happening. You take a company like Texas Instruments, who were the pioneers of the silicon transistor, or Ampex, a leader in magnetic tape. These companies were delivering returns in the thousands of %. You could put in a little bit of money and end up with genuine financial freedom. But underneath all that excitement, a whole landscape of hidden dangers was just waiting for the unsuspecting investor. And that gets us to the million-dollar question, right? For every single Texas Instruments, there were tons of other companies that just shot up like a rocket and then vanished without a trace. The very thing that created all this incredible growth, this rapid innovation, also created insane volatility. So the real challenge was, how do you pick the winners? How do you find the companies that are built to last and avoid the ones that are just going to flame out?
Well, to figure that out, we're going to break down the author's entire framework. First, we'll get into the industry's basic paradox. Then, we're going to step into the competitive jungle. And finally, we'll unpack the 4 secret keys he identified for spotting a real, long-term winner in this crazy field. Okay, so let's start with this core paradox. The electronics industry had something huge in common with another giant of the era, the chemical industry, and that was the near certainty of massive growth, all of it fueled by scientific research. But, and this is a big but, when you looked at them as investments, these two industries were from completely different planets.
Now, you gotta check out this analogy because it's brilliant. Think of the chemical industry like the polar regions. Growth is kind of slow, it's steady, but it's really secure. It costs an absolute fortune to build a new chemical plant, which creates this massive wall that keeps competitors out. But the electronics industry? Oh, that's a tropical jungle. Growth is explosive, it's everywhere, but so is the competition. It's this chaotic dog-eat-dog world where a new company can literally leapfrog the industry leader overnight.
All right, so let's put on our explorer hats and head deeper into this jungle. What exactly makes it so unbelievably competitive? Well, the answer is baked right into the economics of the business, and it created a whole new rulebook for investors.
And this table just lays it all out crystal clear. Look at this. In the chemical industry, you had to spend about $1 on new facilities just to generate $1 extra in sales. But in electronics, you could get that same dollar of sales with just 20 cents of investment. That is an incredibly low barrier to entry. It meant basically anyone with a smart idea and a little bit of cash could jump in and start competing, making the whole field crowded and totally unpredictable. So what's the big takeaway here? In an environment where new competitors are popping up constantly and huge government contracts can just disappear on a whim, the old investing playbook gets thrown right out the window. You can't just bet on the industry as a whole and hope for the best. Nope. Your success or failure comes down almost entirely to picking the right company, the one that has what it takes to survive in this jungle.
And this brings us to the author's central thesis, and honestly, it's a total game changer. In a field growing this fast, trying to time the market perfectly, to buy at the absolute bottom, is way less important. Why? Because a really great company is going to grow so fast that even if you buy it at a high price, it'll probably look like a bargain just a few years later. The real challenge, the thing that separates the winners from the losers, is figuring out which stock to buy in the first place.
So the author lays out 4 key things to look for, and these aren't just about finding a company with a cool product or a good quarter. This is about finding companies that have deep, durable advantages that will let them weather any storm the competition throws at them. So let's break down each one. Okay, key number 1, research leadership. Now, this seems obvious, right? In an industry driven by tech, you want the innovators. But the author says, hold on. Most investors look at this all wrong. It's not about finding the company with the biggest R&D budget or the one that just hired a famous scientist.
The real goal is to find a company that has a research organization that's built to consistently stay out in front. Texas Instruments is the perfect example. They came out with the silicon transistor, and everyone thought, okay, the big guys will catch up in no time. But by the time they did, TI was already on to the next big thing. They kept their competitors in a constant game of catch-up, and that's the sign of a truly dominant research culture.
And this is where a lot of investors get tripped up. The author points out 2 huge common mistakes. First, don't just throw your money at a stock because some star scientist joined the team. Modern research is all about teamwork, not some lone genius. And second, don't get fooled by big R&D spending numbers. There is a massive difference in research productivity. Some companies just get way more bang for their research buck than others. Just looking at the dollar amount is a classic rookie mistake.
So if it's not about star scientists or huge budgets, what does real research success look like? Well, it all boils down to teamwork and coordination. It's when the research lab is constantly talking to the sales team to find out what customers actually need, they're talking to the production team to figure out how to build things more efficiently, and they're talking to top management to make sure all that brainpower is aimed at the biggest, most profitable markets. That integration is the secret sauce.
All right, let's move on to key number 2, which actually builds on the first one. And it's all about understanding the massive role of the military in the electronics industry back then. In the 1960s, you just couldn't ignore the US government's influence.
Just get a load of this number, 49%. Almost half of the entire industry's business came directly or indirectly from the United States government. Pretty much all of it for military stuff. This was a gigantic force shaping the fate of every single company in the field. And you can see it right here. That is a massive slice of the pie. Now you'd think, great, a guaranteed customer. But here's the catch. From an investor's point of view, this business was a total double-edged sword. It meant huge sales, sure, but it also meant instability, razor-thin profit margins, and a whole bunch of unique risks.
Now this quote, this one really nails the problem. See, back in World War II, you'd engineer one tank, and then you'd build thousands of them. Pretty profitable. But in the Cold War, technology was moving so fast that companies were doing insane amounts of engineering for weapons that were basically obsolete the second they were designed. So you'd get these tiny production runs. All the profit was supposed to be in production, but the production orders kept shrinking.
So the smart play, the winning strategy, wasn't to run away from military work. It was to be incredibly picky about it. The best companies went after government contracts that let them develop new skills and new technology, often paid for by the government, that they could then turn around and use for their more stable, more profitable civilian products. They created a synergy where the defense work actually fueled their commercial side. This brings us to our last 2 keys, and they are all about building a defense. You know, a moat around your castle. In a jungle this fierce, having a great offense isn't enough. You need a powerful defense to protect what you've built from all the rivals trying to take you down. And these are the 2 pillars of that defense.
Key number 3 is an ironclad reputation for quality. Take Ampex, for instance. For their high-end equipment, customers just weren't willing to risk failure by using a cheaper, less proven brand. That reputation was a powerful shield against price wars. Then you have key number 4, a superior marketing and sales team. Because when that here today, gone tomorrow government business dries up, you better have a strong network to sell your products to a wide range of civilian customers. That's your ultimate safety net.
And what this all really boils down to is a fundamental shift in thinking. We're always obsessed with growth, right? How fast is the company growing? But in a wild, unpredictable industry like this one, the ability to simply avoid getting knocked out by a competitor is just as important, maybe even more important than your growth rate. A company that can grow fast and defend its turf, well, that's the holy grail for an investor.
And that leaves us with this final big question. We've just spent all this time in a 1960s world of transistors and military hardware. But what about today? In our world of software, AI, and the cloud, do these old-school rules for finding durable companies still hold up? Think about it. Does a company's research culture still matter? How do today's tech giants deal with government work? And what are the modern-day modes that protect them from competition? As you look at the big tech companies of today, ask yourself, do they have these timeless qualities? It's a fascinating question, whether the rules of the jungle have really changed or just the animals living in it.
Imagine it's the 1960s. There's this tech revolution just creating fortunes basically overnight. And no, I'm not talking about Silicon Valley. I'm talking about the world of wonder drugs. We actually got our hands on an old investment analysis from that era, and we're going to dig into it to see if the rules for investing in radical, game-changing innovation have really changed at all. Right out of the gate, the analysis promises these lush gains, but there's a huge catch. These rewards were only for the alert investors. You know that tells you everything. This wasn't just some booming market where you could throw a dart and win. It was a complex puzzle, and only the sharpest players were going to come out on top. So how did these alert investors actually navigate this world? Well, here's our game plan. First, we'll look at the wonder drug opportunity itself. Then we'll see why not all growth is the same. After that, we'll dive into the huge risk of obsolescence, uncover the hidden forces that actually stabilize this crazy market, and finally, we'll lay out the actual 1960s playbook for picking the winners. All right, so let's start at the beginning. What kicked this whole revolution off? It wasn't some slow, gradual thing. It was an explosion of innovation, really forged in the fires of war and massive scientific discovery. You see, the seeds were really planted during World War II, with the urgent need for things like antibiotics. But the real game changer, that came in the late 40s, mass production. All of a sudden, these things that were just lab curiosities became household names. By the 1950s, these wonder drugs were completely transforming medicine and creating this massive, totally untapped market. And here's the absolute key. From an investor's perspective, this wasn't about trying to create demand. The demand was already there. I mean, a deep, fundamental human need for cures. The source calls it an intense and immediate demand. Think about it. For anyone with money to invest, a guaranteed market of that size was just a massive, blaring buy signal. Okay, so you have a huge market, you have breakthrough technology, easy peasy, right? But how do you even classify an industry like this? Our analysis argues that the drug industry was its own kind of beast, a hybrid that just defied any easy labels. And here's the core insight, the big idea. While the science looked a lot like chemistry, the investment profile, pure electronics. What I mean is, the process in the lab might have been slow and methodical, but the market was fast, it was risky, and it was capable of this explosive, just rocket ship growth. And here's why that difference is so important. A big, traditional chemical company, they built these enormous, expensive plants. That's a massive moat protecting them from competition. But a drug company could spin up a new production line, as the source says, quickly and cheaply. That meant they could jump on a breakthrough almost instantly, but it also meant their competitors could too. This is just your classic high-risk, high-reward profile, a lot like the electronics industry back then. The drug industry offered this spectacular growth, but it was all built on a foundation of constant disruption. The analysis makes it super clear this was an investment for thrill seekers, not for the faint of heart. Which brings us right to the central risk of this whole industry, obsolescence. The exact same innovation that created fortunes could, in a flash, destroy them. Today's miracle cure could literally become tomorrow's forgotten relic, all because of one single breakthrough in a competitor's lab. And when you actually looked under the hood of these companies, you found this surprising vulnerability. Their profits weren't spread out evenly across a bunch of products. A lot of the time, just one or two blockbuster drugs were propping up the entire company. I mean, look at this example. Take out just two products, and you could wipe out 75% of a company's profits. Just like that. The implication here is, well, it's chilling. A competitor's breakthrough didn't just ding your sales, it could literally vaporize your company's entire profit engine overnight. The source calls this a quite unhappy effect, which has to be one of the greatest understatements in the history of investment analysis. It's a little more than unhappy. So with this constant looming threat of obsolescence, you just expect a market in total chaos, right? But here's the twist. Our analysis shows there were these powerful, kind of hidden breaks that were actually slowing the pace of disruption and creating a surprising amount of stability. And there were two main breaks slowing things down. The first one was bureaucracy, the FDA approval process. It was slow, it was rigorous, and it gave the established companies time to react to new threats. But the second, and maybe even more powerful break, was just human nature, the ingrained habits of doctors themselves. See, doctors weren't all one hive mind. You had the innovators, who were always chasing the next big thing, but they were balanced out by the cautious ones, who were worried about unknown side effects, and the experts, who had literally built their careers on the old drugs. Altogether, these different mindsets created this powerful inertia that just resisted rapid change. And the result of all that inertia was a market that moved a lot slower than you'd think. A revolutionary new drug had this long, slow climb to the top. And an old, even outdated drug could enjoy a surprisingly long and profitable life, generating cash for years after it was technically obsolete. So how did companies try to fight against this inertia? Well, they deployed an army of what they called detail men. In a world before the internet, these guys weren't just salespeople. They were the main source of information for doctors, educating them face-to-face on the latest breakthroughs from their company. But here's another twist. This system also ended up being a barrier to entry. A busy doctor only has time for a few of these meetings, right? So who do they see? The detail men from the big, trusted companies. This gave the established players a massive advantage and made it incredibly difficult for a new company to even get a foot in the door. All right, so you've got this really complex mix of high growth, high risk, and these hidden stabilizers. How do you actually invest in it? Well, our source lays out a surprisingly clear two-part playbook for the truly alert investor. The playbook was simple, at least in concept, but it definitely required deep expertise to actually pull off. It really boiled down to two crucial skills. First, you had to identify the right companies, and then you had to know the perfect moment to buy. So what did the right company even look like? It needed four things. First, an outstanding research organization. That's the engine of innovation. Second, above-average marketing to get past that doctor inertia we talked about. Third, a sterling reputation, which was really the ultimate currency of trust. And finally, and this is so important, a broad, diverse portfolio of drugs so that if one product went obsolete, it wouldn't sink the whole ship. Ultimately, the bet was pretty simple. You were looking for companies where the scale was always tipped in favor of their own innovation. The money they made from their new drugs had to consistently outweigh the money they lost from their old ones getting pushed out. You weren't just betting on a single product. You were betting on a perpetual motion machine of discovery. And now for the timing. This is where the advice gets really interesting. For most industries, you'd wait for a recession to buy stocks on the cheap, but not pharma. No way. Because people always need medicine, these stocks actually got more expensive during downturns. The real opportunity, this analysis argued, came when the entire industry was under a cloud, maybe facing political heat or the threat of new regulations. That was the moment of maximum fear, and the perfect time to buy the best of the best companies at a discount. And that brings us right back to today. The technology has changed, obviously. We talk about AI drug discovery and CRISPR now, not just antibiotics. But the fundamental dynamics, they feel eerily similar. We still see spectacular growth, we still see that constant threat of obsolescence from a competitor's breakthrough, and we definitely still see massive regulatory hurdles. So the question is, in a world of biotech and personalized medicine, are these 60-year-old lessons maybe more relevant than they've ever been? Is the playbook for investing in the future of health actually hidden in its past? Today, we're doing something a little different. We are cracking open an investment guide that's over 60 years old to see if the wisdom inside still holds up. We're going to explore how looking past simple industry labels might just be the key to finding those hidden gems in the market.
Okay, let's really think about this for a second. I mean, technology, markets, the whole world, it's all constantly changing, right? But do the fundamental principles of what makes a business great really change? We're about to find out, because this old school text suggests that the real secrets to success are, well, pretty timeless.
So to really get this, we've got to rewind the clock. Picture this. It's the post-World War II era. The economy is booming, wages are steadily going up, and there's this incredible feeling of optimism in the air. For investors, this meant one thing. The hunt was on for the next huge growth story.
And the logic behind this was actually pretty simple. With the cost of labor going up, any company that sold something that made workers more productive was sitting on a potential gold mine. The strategy was clear. Find the businesses that help other businesses work smarter and faster, and that's where you'll find some amazing investments.
All right, so if you were an investor back then, where would you be looking? Well, two fields seemed like absolute no-brainers. First, the machinery industry. We're talking everything from big factory equipment to the earliest office technology. And second, the super exciting new frontier of advanced metals. Now, this right here brings up a really interesting problem for machinery companies. Think about it. If you're selling food or chemicals, your customers use up the product and have to come back for more, right? But machinery, it's built to last for years, maybe even decades. So how in the world does a company like that get consistent growth?
Well, the really smart machinery companies figured out they couldn't just sell a machine and then walk away. Their success depended on this powerful two-part formula. First, they had to be relentlessly innovative, always improving their products so customers would want to upgrade. And second, they had to become absolute masters at servicing their equipment.
And this is so key. Servicing wasn't just about fixing broken parts. Oh, no. It was their secret weapon. Great service makes your customers incredibly loyal, and it creates this awesome, steady stream of income from service fees and parts. But here's the kicker. It builds a massive wall around your business. Any new competitor doesn't just need a better machine, they need to build an entire coast-to-coast service network from scratch. Good luck with that. Okay, so you had machinery, but at the same time, investors were going absolutely crazy for what they called the newer metals. We're talking aluminum, magnesium, titanium, the good stuff. These were the building blocks for all the high-tech industries of the day: atomics, aviation, missiles. This was the cutting edge, a super clear path to growth. But here's where things get really interesting. Just when you think you've got it all figured out, machinery over here, metals over there, our 1960s guide throws this massive curveball. It starts to question whether these neat industry labels are even useful at all.
And this quote just nails it. The author is basically saying, hey, all these tidy little boxes we put companies in, they're mostly fiction. In the real world, the lines are incredibly blurry. For example, a company making aluminum is probably way more like a complex chemical company than it is a traditional copper mine. It's the process that matters, not just the label on the final product.
I mean, just think about a company like IBM back then. What was it? You could absolutely say it was an electronics company, but it was also a machinery company. And of course, it was an office equipment company. So, which one is it? Which box does it fit in?
And the author's answer is just brilliant. He says, we're asking the wrong question altogether. Who cares what you call it? The important thing is to look at its characteristics. Does it need the constant innovation and top-notch servicing of a machinery company? Yup. Does it have the fast-paced development cycles of an electronics company? For sure. That's how you really understand the business.
So once you start thinking this way, focusing on how a company operates, not just what industry it's in, a whole new world opens up. And that world is the service industry. In fact, our guide points out that back then, the service economy was actually growing even faster than the part of the economy that made physical things.
The ultimate goal for a service company is to become indispensable. You want to weave yourself into the very fabric of how other businesses operate, providing something that everyone needs and almost no one else can do. A perfect example from that time was AC Nielsen, the company that basically turned business information into a must-have service. And what was so smart about Nielsen is how they built in these different layers of growth. It wasn't just a one-trick pony. First, their existing clients would start using their data for more and more of their own product lines. Then, Nielsen would adapt its services for totally new industries. And finally, they took the whole show on the road and expanded internationally. It was just a brilliant, multi-pronged way to grow. Okay, but you might be thinking, that's great for Nielsen, but what about services where it seems like anyone could just jump in and compete? Well, our guide tackles that question head-on with another fantastic example. Manpower Incorporated, one of the pioneers of the temporary help business.
And this really gets to the heart of the debate, doesn't it? On one hand, the business looks so vulnerable. I mean, how much money does it really take to open a temp agency in one city? Not a ton. But on the other hand, Manpower had built this huge advantage through its sheer size, its years of experience, and its incredible skill at that complex dance of matching the right workers with the right clients. Their excellence became its own defense.
All right, so we've gone from machinery to metals to the service revolution. After all that, what does it all boil down to? What are the common threads that run through all these examples of fantastic companies from the 1960s?
It all comes down to these three timeless things. Number one, you need amazing management that's also ethical. Number two, that management needs to point the company toward fields where demand is just naturally growing faster than average. And number three, the business needs a real moat, something that makes it super hard for competitors to come in and steal their lunch.
And that's the big takeaway here, isn't it? This framework, developed over half a century ago, isn't just a history lesson. It's a tool you can use right now. It forces us to look past the hype and the trendy labels and focus on the bedrock qualities of a great business. Great people, a growing market, and a strong defense. The real question for all of us is which companies today truly fit that timeless model? Now that's something worth thinking about.
Welcome back. Today, we're diving into a really fascinating analysis that pulls apart the post-war economic boom to reveal a lesson for investors that is just, well, timeless. We're going to explore how some of that era's hottest stocks were actually running on fumes, a temporary surge that a lot of people mistook for real, sustainable growth.
Okay, let's jump right in with the big idea from our source. It's this mental trap that gets almost every single investor at some point. It's the simple, powerful, and, often completely wrong assumption that what's been working is just going to keep working forever. It's that classic mistake of thinking past performance is a guarantee of future results.
So here's how we're going to break this all down. First, we'll pinpoint that huge mistake investors were making. Then, we're going to unpack this idea of false growth. After that, we'll look at what a real, sustainable growth engine looks like. And then, and this is the fun part, we'll apply that whole framework to the oil industry of the day, see what the forecast was, and finally, wrap it all up with the lesson that's as important today as it was 60 years ago.
Right, let's get into it. I want you to picture it. It's the late 1950s. The war is a memory, the economy is absolutely on fire, and certain industries, well, they look like they just can't lose. They are the undisputed champions of the market. If you were investing your money back then, your attention would have been laser-focused on companies in these sectors. You've got paper, cement, lumber. I mean, this is literally the stuff they're using to rebuild the world. And their stocks? Oh man, they showed it, delivering absolutely incredible returns to anyone who'd been holding on for the last decade or two.
Looking at it now, it seems like a total no-brainer, right? But here's the catch. Investors saw this amazing track record and just assumed the party would never end. They were basically drawing a straight line from the past into the future without stopping to ask the single most important question: what was really powering this incredible growth?
And that question, well, it gets us right to the heart of this whole thing, the idea of false growth. So let's peel back the layers and see what was actually going on with these companies.
To really understand the boom, we've got to go back to the bust. During the Great Depression in the 30s, these exact same industries were just crushed. They had way too many factories, plants sitting idle, and profits were non-existent. Their stocks were so dirt cheap, you could buy the company for less than the cost of its buildings and machines. Can you believe that? A true bare-bones situation.
So this is the 1-2 punch that created this massive boom. First, you have the recovery. The post-war economy created this tidal wave of demand, and all those old, sleepy factories roared back to life. Then, boom, you get hit with number 2, massive inflation. Suddenly, building a new factory was ridiculously expensive, which made those old, cheap pre-war assets unbelievably profitable.
Our source has this brilliant term for it: a one-time journey from rags to respectability. This wasn't real, repeatable growth. Nope. This was just the market finally realizing that these beaten-down assets were valuable again, and the whole process got a massive boost from inflation. It was a recovery story, plain and simple, not a growth story. Now, to really get a handle on this false growth idea, it really helps to compare it to what true growth actually looks like. So let's check out a completely different, much more sustainable way to build value over the long haul.
And this chart just lays it out perfectly, right? The false growth gang, they just got lucky. They benefited from stuff happening around them, the recovery, the inflation. Their profits came from old stuff becoming valuable again. But the true growth stocks, your chemicals and electronics companies, they were making their own luck through innovation, through new products they invented in their labs. It was a cycle they could repeat over and over.
See, the point is, for these true growth companies, value wasn't just being rediscovered. It was being actively created. Their engine was research and development. It was a machine designed to churn out new products and new profits, year in and year out. It's a totally different ballgame.
All right, so we've got our framework, right? False growth versus true growth. Let's put it to work. We're going to take this lens and apply it to another huge, beloved industry from that time, petroleum, oil. For about 15 years, oil stocks were the absolute darlings of Wall Street. And you can see why. I mean, look at this list. It's an investor's dream. Sales and profits were going up and up. They kept finding more oil, so their assets were growing. And all the big money, the institutions, they couldn't get enough. For all intents and purposes, these stocks looked bulletproof.
But if you started digging a little deeper, if you looked under the hood with our new framework, you'd start to see some cracks appearing. Demand at home was slowing down. The surprising popularity of small, fuel-efficient cars was a threat. Other fuels were starting to compete for home heating. And here are the big ones. It was getting more expensive to find new oil, and you had this rising tide of nationalism in oil-producing countries that put foreign operations at risk.
So what gives? You've got this amazing 15-year track record on one side, but then you have all these new, scary threats popping up on the other. Was the whole industry about to fall off a cliff, or was something else going on?
Well, the forecast in our source material was actually super nuanced. It wasn't a story of boom or bust. On one hand, a total collapse was pretty unlikely. Why? Because the big oil giants controlled all the important stuff: the tankers, the storage, the gas stations. Plus, there was so much oil coming from so many places, no one country could hold the world hostage. But, on the other hand, the golden age was definitely over. Those producing nations, they wanted a bigger and bigger piece of the pie, and that was squeezing the profit on every single barrel of oil.
And this brings us to the final guess, as the author put it. What happens when you smash these two giant opposing forces together? The prediction was that more barrels being sold worldwide would be almost perfectly canceled out by shrinking profits per barrel. The net result for the bottom line? A big fat zero.
So the final call was pretty simple, really. It wasn't that oil companies were headed for disaster. Not at all. But that incredible run they had, that period of magnificent performance, yeah, that was over. The easy money was gone.
Okay, let's bring this all home. Why are we spending all this time talking about the paper, cement, and oil industries from the 1950s? I mean, what's the big lesson for us right here, right now? Here it is. The lesson is that while the names of the industries and the stocks always change, the core principle never does. We have to be detectives. We have to look past the sexy stock chart and really investigate the why. We have to understand where the growth is coming from and what the quality of that growth really is.
So here's the mental model you can take away and use on anything. Whenever you see a hot stock or a booming industry, you ask these questions. Is this growth coming from something the company can do over and over again, like great R&D? Or is it just luck, a one-time event? And the big one, can this keep going or has that perfect storm already blown through? And that leaves us with one last big question for you to chew on. As you look out at the market today, at all the companies and industries that seem absolutely unstoppable, which ones might just be benefiting from their own temporary perfect storm? Which ones could be on that one-time journey from rags to respectability, powered by an engine that might not be as sustainable as everyone seems to think? Something to think about. Thanks for joining me.